Okay. If you look at the exam structure that I've given to you, like if you look at the question, we have the exam structure at the top. If you look at the exam structure, you see that financial risk management is coming for 15 marks. Okay. Mostly they can bring theory questions on the financial risk management. All the questions will be theory and they will be 15 marks or 10 marks. Or sometimes they will bring a calculation question for 10 marks and then they will bring theory question for 5 marks. Okay, so the minimal marks that you can get on the financial risk management will be 10 marks. Okay, will be 10 marks. Okay, will be 10 marks, but they can't set a question below 10 marks. Okay, it will be 10 marks. Whatever be the case, you see a 10 marks or 15 marks question on financial risk management. Okay. What you have to know is that the financial risk management, we are going to be looking at what we call uh, exchange risks and also what we call the interest risks. So the company is trading with other companies and their currencies are different. The company will buy and they will not pay on time or they will delay the payment and the time that they are going to pay, the exchange rate might not be the same. The exchange rate might not be the same. So they'll be having some kind of exchange rate losses over there. And that is also a financial risk. That is as a result of you delaying your payment. How do you manage that? That is what we are coming to talk about. Company might also be having a subsidiary, a foreign subsidiary that at the consolidation level, they have to translate the activities of the foreign subsidiary to the presentation currency of the parents. And in translating, there will be a gain or loss from that. And that is also one of the financial risk management. So what you have to know is that we have 3 types of financial risks or exchange risks. Let me make it exchange risks. We have 3 types or currency risk. Okay, we have 3 types of currency risks. These are what we call transaction risk. Okay, one of them is what we call transaction risk. Okay, so let's look at the types of currency risks. Okay, types of currency risks. Okay, the first one is what we call the transaction risk. Okay, the transaction risks. We have the translation risks. Then we have the economic risk. Economics risk. Okay, they are all very simple. Transaction risk is a situation where you buy from or you sell to a foreign subsidiary or you sell to a foreign customer or you buy from a foreign company on credit. You are not going to be paying. You are buying on credit. Okay, so the delay over there, the delay in settlement, at the time that you purchase the item, the exchange rate might be 6 cedis to $1. By the time that you are paying the amount, the exchange rate now is 8 cedis to what? To $1. You are facing what? An increase of 2 cedis as a result of you delaying the settlement. So that particular 2 cedi that you are paying for, that additional 2 cedi that you are paying is what we call the transaction risk. Why are you paying for that additional 2 cedis? Because of you delaying your what? The settlement of the debt, or you entering into a transaction that you are going to pay at a later date. So what you are having over there is what we call the transaction risk. The translation risk is always covered under the IAS 21. Okay, mostly in the corporate reporting. So the transaction risk is always covered under if you are accounting for foreign subsidiary in corporate reporting. So we have a company in Ghana here, and they have a subsidiary in Nigeria. You see that the company in Ghana, the parent company in Ghana, will be presenting their financial statement in the Ghana cedi, but the subsidiary in Nigeria will be using the Naira. But if you want to prepare a group account, you have to put the 2 entities together. So it means that the group account must be prepared in the parent's presentation currency, which is the Ghana cedi. So we have to translate the activities of the subsidiary from Naira to Ghana cedi. So if you are translating, there will be some kind of loss or some kind of gain over there. And that's what we call the translation risk. So the translation risk comes in as a result of a company having its operations in a different country. Okay, that is the translation risk. So the attempt to translate the profit or loss items and the balance sheet items, there will be a gain or loss on the translation, and that's what we call the translation risk. If you come to economic risk is a situation where the currency of the company is being strengthened or is being weakened based on the microeconomic activities. So the economic risk is always associated with what? The economic activities of the country, mostly the microeconomic activities, government regulations, government borrowing, the policy of the monetary policy of the government, the fiscal policy, all those things, they are being created by the economic activities of the country. So assuming if we are a company in Ghana that we are producing, what are we producing? Okay, we are producing books. Okay, we are a company that we produce books in Ghana and sell locally. Okay, and sell locally. So we produce and sell to what? To the domestic customers. Okay, if the Ghana cedi is now strengthened against the dollar, you see that people who are importing, the importers will now be enjoying some kind of benefit and we will be suffering. Because these people, they will now import the books at a price that will be cheaper because the Ghana cedi is now strengthened. The Ghana cedi is now strong against the dollar. So if you are importing, the amount of money that you'll be paying for the imports will not be rich as compared to if we are producing locally. So these people, they will buy the books at a price which will be lower than what we are incurring to produce. So these people will not be selling the items below the amount that we are selling it. So why are you facing that particular issue? It's because of the currency, the Ghana cedi being strengthened against the dollar. So if the Ghana cedi is not strengthened against the dollar, people who are producing locally will be suffering, and people who are importing will be enjoying. That's what we call the economic risk. The risk as a result of the improvement in the economic activities of the country or the decrease in activities of the country. So they can ask you, they are here to ask about this type of them that you should explain them. So they can ask you, and they'll also ask you to list or explain them. So we have so many ways of managing the increase in the exchange rate. We have the internal and we also have the external. So let's pick a question. If we are moving on, then we'll be talking about them one by one. Okay. Okay, let's pick the question one, which is about money markets, and this is about external technique. Okay, Sinadem, take that question for us.
Okay, financial risk management question 1. It is 1st June, and LMD Limited is anticipating receipt of 1.5 million Great British pounds and payment of 2 million pounds, both in 2 months' time. The spot rate is currently 5 cedis 211 pesos to 5 cedis 2260 Ghana cedis. The spot rate is pound to cedi is currently 5 cedis 21 pesos 211 or 20. 5 cedis 211, okay, to 5 cedis 2260 to £1. Pundits are suggesting that the cedi might weaken against the pound sterling in the month. The directors of the company are considering hedging against potential currency risk using either forward market transactions or money market transactions. Below are information relating to instruments in the two markets. Forward markets, that's the contract specifications. 2-month forward bid rates on 1st June. 5.234 Ghana cedis to £1. Then 2 months forward at rate on 1st June, 5.249 Ghana cedis to £1. Money market annualized interest rate on 1st June. Investing rate and borrowing rate. Ghana and United Kingdom. 24% investing rate and then 28% borrowing rate. United Kingdom, 2.4 investing rate, 3.6 borrowing rate. Required. What kind of currency risk exposure is the company facing? Explain. B. Should LMD hedge its currency exposure using forward market hedge or money market hedge? Support your answer with relevant computations. C. Discuss how the company can lead or lag the expected 1.5 million pounds receipt.
All right, thank you, sir. Okay, so you can see that the company will be receiving what? 1.5 million what? Pounds, and also they will be paying what? 2 million pounds, both in 2 months' time. So in all, how much will the company be paying? In all, how much will the company be paying?
500,000.
Okay, the company will be paying 500,000. Yes, it's very simple. You are receiving 1.5 from in the same currency in 2 months' time, and you also be paying 2 million. So what you do is that you receive the 1.5 down, then you add what? The 500,000 to it to make it 2 million, then you pay. So what we do is that if the expected receipts and the expected payments are going to be within the same period, then we do what we call netting. So if they are both in 2 months' time, so if you are going to do this, you receive the 1.5, then you now put the 1.5 there, then you go and what? Change a Ghana cedi to 500,000 because you are left with 500,000 to add to the 1.5 to make it what? 2 million. So what we do is that we do what we call netting. You match the receipt against what? The payments, if they are all within the same period. If the receipt will be in 2 months' time and your payment will be in 4 months' time, we can't match. So we do the two of them separately because you'll be receiving before you'll be paying. So we do all of them separately. But this one, they are all within 2 months. So we can do what we call the netting. Okay. So in all, the company will be making a net payment of what? 500,000 pounds. And that is what they will be what? They will be hedging. That is what they will be hedging. That is what they will be managing. Okay. Let's now, what kind of currency risk exposure is the company facing? Explain. What of the exposure? Which of them are they facing? Is it transaction, translation, or economic?
Transaction.
Okay, they added over there that you should explain. So we are waiting for the explanation.
It is transaction because it involves the day-to-day transaction activities of the company.
Okay. 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 Someone should. Anyone else?
Okay, I want to come in.
Okay.
That it is a transaction risk because it involves a company involving itself in a business transaction with another company outside the shores of Ghana, which is UK. And so any business that goes on between the two of them, or the exchange rate comes in due to the transaction that occurred between the two of them.
Okay. That is nice. That is nice. So that is very simple. That is it. That is what you have said. So it's a transaction risk because whatever will be happening over here is because of a transaction that happens between these two parties. This particular payment is coming as a result of a transaction that happened between the two of them. All right. So it's a transaction risk, and that is the explanation. So the question now is, they are asking whether they should hedge its currency exposure using forward market hedge or money market what? Hedge. Support your answer with relevant computations. So the forward market is a situation where the company, the LMD Limited, will go to an agreement with a bank that, okay, I'm going to be paying £500,000 in 2 months' time. So I want you to give me an exchange rate today that will be applicable in the 2 months' time for the fixed amount. That is what we call the forward. the forward contract, or the forward exchange contract. Okay. Or the forward agreement contract, anyhow you call it. Okay. So the forward is you are going to be paying in 2 months' time. So you go into an agreement with someone, or usually a bank. So the bank will guarantee you, or will give you an exchange rate that will be applicable in the 2 months' time. And whatever happened, that rate will not be changed. Okay. So you can see that they are asking us whether we should use the forward market hedge or the money market. So we'll be doing workings for the two of them and see which of them will be giving a favorable position to the company, and you choose that particular one. So the forward market is very simple. You just determine the forward rates. Okay, the forward rates. Who is going to be between the bank and then the company? Who will be selling the 500,000? Is it the bank that will be buying, or the company that will be buying? Okay, so you have to know that the bank is always there to make profits. Okay, so you first ask yourself, this particular, so our figure is 500,000. Okay, our figure is 500,000, and you can see that the exchange rate is what is the pounds to Ghana cedi. Okay, so right now we are having currently, or in 2 months' time, this is what currently this is £1 is equal to either any of them, because if the bank is buying, the bank will use the lowest rate. Okay. Okay. Now we are looking for 500,000. If one is equal to this one, 500,000, are we multiplying, or we'll be dividing? Are we going to be multiplying to know the cedi equivalent, or we'll be dividing? Looking at this one, we'll be
We'll
multiplying.
multiply.
Okay. If you are multiplying, you have to know that the bank will always sell at the highest rate, because the bank want to make profit on the transaction. So the bank will always sell at the highest rate, but they will buy at the lowest rate if you are multiplying. But if you are dividing, the bank will sell at the lowest rate and buys at the highest rate, because if you are dividing, the lowest figure will give you the highest amount, and the highest figure will give you the lowest amount. So if you are multiplying, the bank will buy at the lowest rate and they will sell at the highest rate. In the same way, if you go to our border, that is how it works. If you are using the CFA for Ghana cedi, okay, if you are using CFA for Ghana cedi, you have a CFA, you want to take Ghana cedi, they will give the amount to you at the lowest rate. But if you have cedis and you want to change it to the Togo CFA, they will give you at the highest rate. Why? Because they want to make profit on the transaction. So the bank will always sell at the highest rate if you are multiplying, and buys at the lowest rate. Let's now come here. Which of these is the highest rate? The 2 month forward rate. Which of them is the highest rate?
The ask rate.
Okay, so the ask rate will always be the offer rate, or the rate that the bank will be selling. The bid rate is the rate that the bank will be buying the instruments from the customer. So if the customer is the one who will be receiving this one, it means that the bank will be the one that will be buying. So you use the bid rate. But right now, it is the customer that will be paying. So they will be buying the pounds from the bank with Ghana cedi. So the bank will be selling to them at 5.24. That is the forward rate that is being agreed today in 2 months' time. So you use this amount to multiply the 500,000. That will give you the amount under the forward. So the amount will give you the forward rate multiplied by the the payment amount, or let me get, I don't want to write amount again. So that will give us 4 point what? 5.2490. 5.2490 multiplied by 500,000. Okay. You want to make profit, so you can't sell at the lowest rate and buy at the highest rate if you are multiplying. No. The bank will always sell the currency to you at the highest rate. But if you want to sell to them the same day, they will give you their what? Their buying rates. It will shock you that the same rate, the same amount that you are selling to them, if you want to buy it back, they will give you to you at the highest rate because they are there to make profit. All right. How much are we getting?
Now, 2,624,500.
Okay. 2,624.
6,500.
Okay. So that is the amount that they will be paying under the forward contract. So the forward contract is very simple. Just determine the amount and determine the forward rate. Just multiply or just divide. That is the amount that you'll be paying. So the 500,000, the bank will be selling it to you in 2 months' time at this rate. So what is the CD amount that you'll be paying for it? All right.
Linus, please, your voice is down small, please.
My voice is down. Is it for everybody or?
I think it should be at her end.
Yes.
Because
So,
I'm
Maybe it's from
hearing
your
you loud.
okay. Because myself, I realized I'm shouting. Okay. All right. Let's now come to the money market side. You see, the money market side is the one that always what pose a greater challenge. Mostly the company is the one paying. But if the company is the one receiving, the calculation is very simple. We use the idea of future value and present value. Okay. All right. You see, the company will be paying 500,000 in 2 months' time. Okay. What they will do is that they will go to the bank. They will go to the bank and borrow this amount in cedis. They will go to the bank and borrow a certain amount in cedis and invest it for 2 months. So they'll go to the bank today. The company will go to the bank today and say that, okay, we are paying 500,000 in 2 months' time. So we want you to borrow an amount to us today. The money market hedge, it counts with trading. You borrow the amount and invest it. So it counts with investment and borrowing. Okay, so the company will go to the bank today and say that, okay, we are going to be paying 500,000 in 2 months' time. So we want you to borrow the equivalent amount of this amount that we can that we can invest today, so that at the end of the 2 months, we'll be getting this total amount and pay. So you borrow us the equivalent of this amount in cedis. We are going to be paying you in cedis. So the company will go to the bank and borrow the equivalent of this amount. Okay, this will be borrowed in the foreign currency. So the company will go to the bank and borrow this amount. Then they will now invest it. So they will invest it at the end of the 2 months. Then this will be the amount. Okay, the question now is, what is the amount that we are borrowing? Or what amount that in pounds, if we invest it for 2 months, we will be getting what? The 500,000. So what we do is that we don't know the amount. So we say that we are investing the pounds equivalent today. That will be invested at what? The investing rate is what? Is 2.4, isn't it? Okay, so that will give us 1 plus R over M. The rate will always be given to you yearly. So 2 months you divide by 6. Okay, then this will be exponent M times N. Then this will now give you the future value of this amount. So it means that you are investing a certain amount of pounds today at an interest rate of this one. And at the end of the 2 months, you now have a total amount of this. So the question now is, what is the amount in pounds are we investing today? So that 2 months time, it will give us the total amount. Then we go and pay the suppliers or whoever we are paying. So this one, if the company is the one paying, they'll go to the bank and borrow the equivalent of this amount that they are going to be paying in cedis. Then they will now put that particular amount on a 2-month deposit. They will put that amount on a 2-month deposit so that at the end of the 2 months, they will be having the 500,000. So how much should we deposit today? That is how the question will start. How much should we deposit today? So that in 2 months' time, we'll be having what? The 500,000. So you ask yourself, if you want to know the 500,000, it will be the amount that you are depositing today multiplied by what? The increment. Then that will give you the amount that you are going to be depositing today. So we find it from that side, the money market hedge. Okay, so the money market hedge, you first have to know the amounts that you'll be depositing so that at the end of 2 months, you'll be having 500,000. So how do you find that particular 500,000? Okay, the 500,000 will be calculated like this. Okay, you see that the 500,000 will be calculated like this. It will be equal to the amount plus 2.4 divided by 6 because it's 2 months. So 2.4 is, so let me do it like this, 0.024 divided by 6 times the amount that we are depositing. So it will be the amount that we have deposited plus the interest that will give us 500,000. In compound interest, what we do is that we can do this as a future value. We can do this as a future value. How do we do it? We can just come here and say that, okay, our 500,000 is calculated as the amount plus the what? The increment of this one. So this amount will increase by this one. That is how we increase it. Okay. So let's calculate, let's just play with this formula to calculate the amount that we should be putting on deposit in pounds. So we have the amount to be equal to the future value divided by, so let me just make it present value here. So we have the present value is equal to 1 plus R exponent M times what? N. Okay. So we can now go ahead and say that our present value in pounds, will be equal to the 500,000 divided by 1 plus 0.024 divided by 6 because it's 2 months. So this one, what you do is to just be 1. Okay, because we are doing 6 months already. But if you are to do 12 months, then it means that the rate that you are getting over here is monthly. Then you put 2 here. You'll be getting the same answer. But this one, you're just finding what? The 2 months rate, because this is the 2.4 is a yearly rate. So you are doing for what? 2 months. So if you are doing for 2 months, if you divide 12 by 6, the answer will be 2. So if you divide this rate by 6, it means that the rate that you are getting will be 2 months rate automatically. But if you do it divided by 12, then it means that you have to exponent this one because the rate that you are getting over here is monthly rate and you are doing this for 2 months. So you exponent it by 2. Okay. But since we are doing it for the 2 months directly, our exponent will be only 1. Okay. So it means that the 2 months will be done only once. The compound will be done only once because 2 months is only once. Okay. What are we having? Give me the total answer. Is that done correct? 500,000 divided by 1.04. 1.004. All right, I'm getting present value of GBP, which is 498,008. Okay, so this is the amount that we'll be borrowing, and we put it on deposit. This amount will be borrowed in Ghana cedis. So this is the amount that we have to borrow today and put it on a deposit that will attract 2.4% interest annually. Okay, but this, since we are borrowing, we'll be borrowing this amount in cedis. So we find a cedi equivalent. Okay, we find a cedi equivalent of this amount. So the cedi equivalent of this amount. Okay, this amount will be borrowed at the as at today. So we always use the spot rate to translate the amount. So this amount will be bought today. So we use the spot rate to translate it. So let's go to the question and use the spot rate. So this is the amount that we have to. Yeah, Adams, your hand is up.
Linus, please, sorry to disturb you. When will the videos be ready? Maybe after the lecture, so please.
It depends on the time. I can make it this evening. I can make it tomorrow in the morning. All right. So this is the amount. This amount will be borrowed today, but you are going to be borrowing this amount in Ghana cedi because you'll be paying in pounds. So you are going to be borrowing the cedi equivalent of this. You'll be borrowing the cedi equivalent of this, or you'll be buying the cedi equivalent of this from the bank. So we still use the spot rate, but the spot rate will be 5.2260 because the bank will be selling this amount to the company. It's just like you want to make a payment to someone in a foreign currency. So you want the bank to handle the transaction for you. So what the bank will do is that you go to the bank today and have an arrangement with the bank. So the bank will say that, okay, if you want to invest the foreign currency, okay, if you want to invest it today, the rate is what, 2.4. So it's just like, okay, you want to start hedging for the 500,000 today. So you go to the bank and put an amount in the bank so that in 2 months' time, it will give you the 500,000. How much should you be putting in the bank in the foreign currency? And that's how we have calculated. But the bank will be the one that will be managing this for you. The bank will put that particular amount in the account for you. The bank will be putting that particular amount in the account for you today. So that in 2 months' time, it will be 500,000, then you now pay. Okay. But that particular amount that the bank is giving to you, they will now be receiving CDs from you. You will not be doing anything. It will be the bank that will do everything for you. Then you come and pay them after the 2 months. So the bank will carry out this transaction for you. But the amount that they are putting there, they will translate it to Ghana cedi, and they will charge interest on it for 2 months. They are borrowing the amount, so they will charge interest on it for 2 months. So the amount that we are putting there is the pounds equivalent. So what we do is the bank will be selling. The bank will not be buying. You are not the one receiving. You are the one paying. So the bank will be selling that particular amount to you. So we use the exchange rate 5.2260 to find the cedi equivalent of that. So 5.2260. What are we having?
So we're having 2,602,589.8.
Okay. So 2589.8. Okay, so this is the cedi that a bank will be expecting to receive from you. But you will be settling this transaction after 2 months. So the bank will now charge interest. The bank will now charge interest on this one. This is a cedi. The bank will charge you interest. You are borrowing. So the bank will put this amount there and they will charge you interest in 2 months' time. Then you come and pay. So let's look at the cedi amount in 2 months' time. So the cedi in 2 months' time. So the cedi in 2 months' time will be the 26025889 29.8. Then you multiply by the borrowing rate in the city. The borrowing rate in the city. That will give you 28%. So the total amount will be, this place is not big. Okay. So let me look at the CD amounts. So the CD will be 262589.8 multiplied by into bracket 1 plus 28%. Or let me just make it 0.02, 0.28 divided by 6. This will give you 2 months. So multiply and give me the full answer.
All right. I got 2724.
27.
2724 044.
Okay. So this is the total amount that the company will be paying after the 2 months under the money hedge. So you compare the two. The forward contract, they will be paying 2624,500. But under this one, they will be paying 2724,044. So you now advise them which of them they should go for. So based on this one, which of them they should go for?
You go for the forward hedge.
Okay. So why should they go for the forward hedge? You have to. The forward hedge.
Okay. The forward hedge will give them the lower amount to be paid for the equivalent in the pound sterling
Okay.
as
So
compared to the money market.
okay. So mostly what you do is that you just state the cost savings that they'll be making. If they're using a forward contract, they will be saving a cost of the difference. So you find a difference between them. Okay. So if they are using the forward contract, they will be saving this amount of this one, which will be 27 something something minus the 2624,500. So the payment one is always the one that comes with a problem. But if it should be the company that will be receiving that amount, the calculation is always simple. So I'm receiving 500,000 in 2 months' time. Okay, I can't wait for 2 months before I'll be getting that particular amount of money. So what I will do is that, okay, I will say, okay, now give me a certain amount today so that in 2 months' time, if I'm able to receive that money, I can pay all the money to you. So the bank will now be lending the forward amount to the company because I'm receiving 500,000 from someone. I need money today. So what I will do is that you give me money so that in 2 months' time, I can give you all the money. So you factor in the time value of money. So if it is the company that is actually receiving the money, what we do is very simple. The bank will be borrowing to the company in the foreign currency. So I'll give you a certain amount today so that in 2 months' time, it will be up to what? 500,000. So the bank will be lending to the customer or the company in the foreign currency. But if you count to the payment, the bank will be lending to the company in the local currency. That is the two difference. Okay, let's go to the last side of it. They say discuss how the company can lead or lack the expected what? 1,500 what? Receipts. Okay, I hope we know what we call the leading and lagging. Adam, what is meant by leading and lagging? Adam, are you there?
Yeah, I'm here.
Okay, what is the meaning of leading and lagging, or to
Okay,
lead a
so
payment or to lag a payment? What is the meaning?
leading is agreeing at a rate and then paying in advance. So, or you agree that maybe in 2 months' time I'll pay you at this rate. And then lagging is you delay small because of maybe the exchange rate fluctuations. You delay small and see if the rate will drop before you pay.
Okay,
That is my understanding.
okay, that is not bad. Okay. Okay, so the leading is a situation where the company will estimate the future rates changes, and they will say that, okay, maybe in 2 months time, if you want to pay, this amount is going to be like this amount. So what we are going to do is that let's make advance payment, or let's settle the amount before the transaction itself. So the company can decide to say that, okay, you people, since the exchange rate, since we are receiving the money, since the exchange rate will be going in our favor or will not be going in our favor in the 2 months time, they can say, okay, you just pay the amount before. So they can decide to sell the 1,500 to the bank if the exchange rate is favorable. So if the exchange rate is favorable and you try to settle the transaction or sell the amount before the actual day, that is what we call the leading. Okay, the lagging has to do a situation where you see that if you should sell the amount right now, you'll be making a loss. But if you wait small and sell it, you'll be making a gain. And that is what we call you are lagging, you are delaying it. So you look at it, if the exchange rate is favorable, you sell it now. If it is not favorable, then you wait till it is favorable, then you sell. That is what we call the leading is you paying before the time, or you encouraging the people to make advance payment to take advantage of the favorable exchange rate, or you telling the people to pay at the actual time that they should pay because you know that the exchange rate at that time will go in your favor, and that is what we call the lagging. All right. Okay, let's take the next one. So the leading has to do with you taking the step first before the payments. So you can decide to make the payment in advance. So advance payments can also be part of the leading. By you looking at the exchange rate, say that, okay, if I should pay right now, it will not favor me. Okay, so let me wait small for the exchange rate to come down or to go in my favor, then I'll pay. And we say that you are lagging so leading and lagging is one of the internal techniques that a company can use to manage their currency risk exposure. Okay, let's come to the question 2. The question 2 is also this one, but what I will do is that I will not do the calculation for the money and that particular one. I will just explain these ones to you. Okay, and also the some of the requirements. Adam, pick the question 2 for us.
All right, question 2. Grain Company is a UK-based company which has the following expected transactions. 1 month, expected receipt is $240,000. 1 month, expected payment is $140,000. 3 months, expected receipt is $300,000. So, the finance manager has collected the following information. Spot rate dollar to dollar per pound. Then 1 month forward rate, 3 months forward rate. Money market rate for grain co. It's as follows. Assume that it is now 1st April. Required A. Discuss the difference between transaction risk, translation risk, and economic risk. B. Explain how inflation rates can be used to forecast exchange rates. C. Calculate the expected sterling receipts in 1 month and in 3 months using the forward market. D. Calculate the expected sterling receipts in 3 months using the money market hedge and recommend whether a forward market hedge or money market hedge should be used. Yeah.
Okay.
Done.
Okay, so let's look at the first one. Discuss the difference between transaction risk, translation risk, and economic risk. I hope I have explained that one at the beginning of what? The lesson, isn't it? Okay. So their definition is more than the differences. So you can just state, or you can just write their definitions one by one, and that is, the definitions will not be the same. So the definition, what you are saying there is the difference. Okay, so discuss the differences between the transaction risk, the translation risk, and then the economic risk. You can explain them. That is all. You are good to go. Explain how inflation rates can be used to forecast what? Exchange rates. Okay. In the normal class, we call something purchasing power parity. We call something purchasing power parity. So the forward rate can also be calculated or estimated using either the interest rate parity or the purchasing power parity. What do we do? The assumption is that the only thing that is going to be affecting the exchange rate movements in the two countries will be the respective inflations in those countries. So what we do is that we factor in the inflation in the two countries. So we try to adjust the spot rate for the two companies or for the two countries using their respective interest rates. Okay, so what we do is the forward rate, which is always the XO, is calculated as, okay, let me make it the X1. Yeah, correct. No, I don't carry. I don't carry. Yeah, this senior C. So what we do is this one is calculated as the XO multiplied by 1 plus the inflation rate, which is H, and this will be I. Then we have 1 plus the HB. Okay, so the HB will always be the home currency, and the HI or the HC will be the counter currency. So we use the inflation rate. The only thing that we use is that we use the inflation rate to adjust the spot rate. So the assumption is that the only thing that can affect the exchange rate in the two countries is the respective inflations in their country. So we try to adjust the rates or the spot rates by the respective inflation rates in the month that, or in the period that the payment will be made. We also use the interest rate, which we call the interest rate parity. So that is how we use the inflation rate. We try to adjust the spot rate for the two countries. If $1 is now, if $1 is now 5 cedis, and we are saying that in the two countries, in the 2 months' time, their respective inflation rate will be 2% and 5%. In 2 months' time, what will be the Ghana cedi? Taking into consideration the inflation rate. In 2 months' time, what will be the value for what? For the USD, taking their inflation into consideration. Then you will now use the new amount to find the exchange rate in the 2 month time, taking into consideration the inflation rate. So the inflation rate, we just use it to adjust the spot rate. That is how we use it to estimate the exchange rate. Okay. So they can also give you a question on that, and they will be asking you to use the inflation rate or the interest rate. This is how we calculate it. The XO is the spot rate. The X1 is the rate in the time that they are asking you. So you take the respective what? Inflation rate. This is always of the home currency. Okay. This is always of the home currency, and this is always of the other currency. The home currency is always the currency quoted in one city, or is always the currency quoted in the one. So if you have one USD like this, is equal to 5 cedi, the HB is the USD. So you take the inflation in the United States. But the other currency, which is the counter currency, is always the what? The the other currency, which is the 5 CD or something. Okay, so they can give you a question on that, and they will give you the inflation rate. The inflation rate, we assume that they are all annualized rate, they are all per annum. So if you are doing for 6 months, you find your 6 month rate. So if the exchange rate is 5%, it will be 0.05 divided by 2. That is 6 months. Then you go ahead to calculate your rate. Okay, that is not an issue. Okay, calculate the expected sterling receipts in 1 month and 3 months using the what? The forward market rate. So let's kill that one and then move on. Okay. Let's come here. How much are we receiving in 1 month's time? How much are we receiving in 1 month's time?
$240,000.
At the same time, what is happening?
We are paying 140,000.
So what is the net amount?
100,000.
Okay. So you will be receiving only 100,000 because you are paying. Okay. So you are receiving 240 and you are paying 140. So you'll be receiving only 100,000. So you calculate it for only the 100,000. So let's come to the question 2. And we look at the 1 month receipt using the forward rate. So let's look at 1 month. Okay. So we are receiving 100,000. The question now is, are we going to be multiplying or dividing? Okay, the company is based in UK, isn't it? How is the exchange rate quoted? It is
Plus or minus?
okay, is dollar. No, the spot rate is dollar per what?
Dollar per pound.
Okay, so it means that it will be $1. $1. So the USD will be $1 is equal to, okay. So it will be $1 is equal to this amount. So let's assume that the first one is 1.7820. Okay. So right now, what are we receiving? We are receiving dollar, isn't it? So that will be 100,000. Okay. So this one, are we going to be dividing or we multiplying?
You multiply.
We are going to be multiplying, isn't it?
Yeah.
Okay. So this is dollar and this is this amount. So that is how it will, the first one, this amount pay this one means that the first currency will always be the one and the other one will be the one given to you. Okay. But see, look at how this has been what? Look at how this has been quoted. Look at how this has been quoted. Okay. You can see that they have given you 1.7820 plus or minus what? 0.002. 0.002. So what you do is that you find it like the first one. How we did the first one here. We find the lowest rate. So the rate should be like this. It should be like this. They should have to have the lowest rate and the highest rate. How do we find the lowest rate and then the highest rate? Okay. So the rate will be like this. So our spot rate will be like this. Okay, let me put it on the display so that it will be visible to all of us. Okay, so our spot rate will be like this. Okay, the spot rate, the lowest one will be 1.7820 minus 0.0002 dash the highest rate will be 1.7820 plus 0.0002. So if the rate is quoted like this, the plus or minus, they are just saying that this is the rate. But if you subtract the 0.002 from it, that will give you the lowest rate. And if you add the 0.002 to it, that will give you the highest rate. So that is how we calculate it. So the spot rate, if you want to know the lowest rate, you subtract the 0.002. If you want to know the highest rate, you add the 0.02. If you count to the 1 month forward rate too, the same thing. So let's look at the 1 month forward rate. Let's look at the 1 month forward rate here. Okay, the 1 month forward rate will be what? Subtract and give me the answers. 1 month forward rate will be what? Because I'm getting 1.7826 dash dash 1.7832. Is that correct? The 1 month rate is those two
Yeah,
figures correct?
correct.
Okay. So what will happen? Who is now receiving? Who is receiving? Is the company that will be receiving, isn't it? Is the company that is receiving the 100,000, isn't it?
Yes, yes.
Okay. So they will be selling to the bank, isn't it?
Right.
Okay. And the bank will be buying at what? The lowest rate or the highest rate?
Low rate.
Okay.
Low rate.
So multiply by 1.7826. What are we having?
Yeah, multiply by. It's gonna be 1.786. 17826.
Okay. Let's go to the 3 months. Okay. The 3 months, how much is the company receiving?
$300,000.
Okay, you can see that there is no what? There is no payment in that particular year, isn't it? That particular month. So the company will be receiving all the 300,000. So 300,000 multiplied by the what? The forward rate. How much are you having? What will be the forward rate in that month in 3 months? If it is a company that is receiving the money, they will go and sell the amount to the bank and receive the what? The pounds what? Equivalent. But if they are going to be paying, then it means that they will go to the bank and buy, and the bank will sell to them at the highest rate. So you have to know who is having the what? The money. If it is the company that is receiving the money, then it means that they will be converting that particular money to the domestic currency. So they will go and sell to the bank. The bank will buy and give them a domestic amount. So the bank will always what? Buy at the lowest rate if you are multiplying. But if it is the company that is going to be paying, it means that the bank will be selling the what? The foreign currency to them and take the domestic currency. So the bank will sell at the highest rate because they want to make what? Profits. Let's look at the forward rate in the 3 months time. I'm getting 1.7842. Is that correct? Just subtract the 0.004 from this figure. That will give you the lowest rate. Then you add this figure to this one. Then that will give you the highest rate. Okay. What are we having? I hope the 1.7842 is correct. Please, let's confirm that. I hope,
Yes, it's right.
since like all of us over here, yeah, I know that a lot of people are confused right now. It is normal. It is normal, so don't worry. It's normal. But in the exam hall, just put yourself in the shoe of a what? A forest trader, someone who has a forest bureau. So if you are there, you are doing exchange. You do with what? Currencies. If someone is bringing dollar, you will see that the amount that you be exchanging the dollar to the person will be different than if someone is bringing Ghana cedis to buy dollar. You see that if someone is bringing dollar for Ghana cedi, the rate that you'll be giving to the person will be low. That's what the banks do. Okay, so if someone is bringing USD for Ghana cedis, that the rate that you'll be giving to the person will be low. But if someone is bringing Ghana cedis for USD, you'll be giving what? A higher rate to the person or higher exchange rate to the person. The same thing that we are talking about over here. So the company is the one receiving. So we are the one bringing the what? The USD to you. So the rate that you'll be giving to us will be low. But if we are the one coming for the USD from you, you'll be giving us a rate that is higher. And that is what is applying over here. It's just like the forest trading. Okay, so just take it like forest trading and that will be fine. So 300,000 multiplied by that, what are we having?
I got 535,260.
Okay, 535.
260.
Okay, so this will be the USD equivalent that the pounds equivalent that you'll be getting. This is for the money market. This is for forward contracts. Let's come to the money markets. Okay. Let's come to the money markets. Okay. The money market, you can see that the 1 month receipt is what? Okay, this one they are just asking you for the expected receipt in what? In 3 months, isn't it? Okay,
In 1 month
calculate
and in 3 months in the forward market.
the forward market, we have done that already. But the D, calculate the expected selling receipt in 3 months using a money market hedge and recommend whether a forward market hedge or money market hedge should be used. So if I do the 3 months, you look at this, you can actually look at the 1 month. It's also very simple. Okay, who is receiving the money?
The company.
Okay, the company is receiving 300,000 in how many months time?
3 months.
3 months time. Okay, what they will do is that they can't wait till for 3 months before they receive this money. So they will go to the bank that, okay, we are receiving 300,000 USD in 3 months time. Okay, we want you to give us the equivalent, the present value of this amount. So that in 3 months time, the interest that you'll be charging on the amount will, plus the principal that you are giving to us, will be 300,000. Then you just take the 300,000. So it's just like I'm receiving 300,000 from somebody in the United States. Okay, but I want to do something today. I can't wait for the 3 months. So I will come to you that, oh, senior, I'm receiving this amount from this one. So you can't say you are giving me the 300,000 so that the 300,000 will come in 3 months I'll receive. No, because of time value of money. So I'll be giving you an amount, taking into consideration the interest that I'll be charging on this amount if I'm giving it to somebody. Okay, so if the company is the one receiving, they will go to the bank and borrow the money in the foreign currency. They will borrow in the foreign currency. So they will go to the bank now. The bank will be telling them that, okay, if we want to give you any amount that we are giving to you in USD, it will attract what? What is the borrowing in the USD? What's the borrowing rate in the USD?
5.4%.
Okay, that will be 5.4 what percent. So what we'll do is that we are going to be giving you the amount at the what? You say you have 300,000. So we give you the equivalent of this amount at the interest of 5.4. So that in 3 months time, if we charge the interest plus the amount given to you, it will be equal to the 300,000. So the question now is, how much will you be taking from the bank? It's just like invoice discounting. How much will you be taking from the bank in the USD now at the interest of 5.4? So we try to find the present value of that amount. So that will be equal to 300,000 divided by 1 plus 0 points. Okay, 1 plus 0 points. So the borrowing in the USD is that they'll be giving USD, so they'll be borrowing the USD to you. That will be 5.4. So that will be 0.054. But this will be in 3-month time. But the rate is what? Is yearly rate. So we find the quarterly rate because that will be 3 months. So we find the
Okay, so you assume it is quarterly.
Yes, please. 3 months is
Okay.
quarterly. Okay.
Because when I saw that, I assumed that it is first April. I was thinking maybe it will be quarter.
No. It's the rate is always given to you in a year. So money market rate for this one is always, you can see that it's 1 year. Even if they didn't add a year or annualize, the rate will always be given to you. Or if the rate is given to you, just assume that it's a year. And the amount will be received in 3 months. So that will be a quarter. So you divide by 4. So what will be the present value? Let's find the present value and move on. So I'm having 300,000 divided by 1.0135.
So please, you're getting 296,004.
Okay. 296,004. This amount is still in what? USD, isn't it? Okay. So what the company will do is that they will now change this amount to what? To the pounds and now put it on a deposit for 3 months. So what they will do is they will now convert this amount. So the equivalent in pounds. So this is the amount that we are going to the bank to take today. So that if they charge their interest of 5.4 for 3 months, they will now have this total amount. Whenever the money comes, then they will seize it. But the money that we have received from them today, we are going to change it to our currency and now put it on deposit because everything will be settled in 3 months' time. So we will convert this amount and put it now on a 3-month deposit. So we change this one to the currency now, which will always be translated as the spot rate because the company will be taking this amount from the bank at the beginning of the transaction, which is today. So they are doing all of these things today towards 3 months. So this amount will always be translated using the opening rate. So 1.7820 minus 0.0002. I'm having, so we multiply this by 1.7818. Okay, times 296,004. I'm having 527419.93. So this amount will be put on a deposit. So 3 months amounts. So the company will now put this amount on a deposit for 3 months in the local currency. So let's go to the deposit rate for the sterling. That will be 4.6. So the deposit rate is 4.6 for the sterling. So they will deposit the amount for 3 months. So that will be 52741993 multiplied by 1 plus. Let me look at the deposit rate. So 4.6. Okay. So that will be 4.046 divided by 4. Okay, that will be quarterly. 4.046 divided by 4 plus 1 multiplied by 5274 19.93. So I'm having 533 485.26. Okay. All right. So this is the amount that if they are using money market hedge, this is the amount that they'll be getting at the end of the 3 months. So they will go to the bank and the bank will give them the equivalent of the amount that they are receiving. So the bank will borrow to them in the foreign currency. So after you have taken that amount, then you will now convert it to your currency and put it on a deposit for 3 months. Then you come for it because you'll be giving the money in 3 months' time. Okay. So this is the amount that you'll be getting at the end of the 3 months. And this is the amount that you'll be getting at the end of the 3 months if you're using money forward hedge. Which of them is higher?
Linus,
Yes, please.
the equivalent side, the 1.7818, where did you get that one from?
Is a spot rate.
The spot rate. Okay.
Yeah. The company will be the one selling, so the bank will be buying at the lowest rate. So you subtract the 0.002 from the 1.7820.
Okay.
All right. So which of them is higher? I'm sure the money market is higher than this one, 535, and this one is 533. Okay, so the money market is the forward is higher than this one, so they should use this one because this will be giving them a gain of the difference. You look for the difference, and that will give you a gain. Let's take the last question on financial risk management. Then we move on to investment appraisal.
Kindly go back for me. Let me see something to the working sheet.
Okay.
So the 3 months is the future value of the money that you'll be paying, right? In the dollars after borrowing the money.
This one.
The
This one.
533.
No,
Yeah.
no. This one, the future value will still be the 300,000. But what you are going to do is that you are receiving the 300,000 in 3 months' time. You don't want to wait till 300,000 before you receive the 300,000 and go and sell to the bank. So you want to go into selling and buying. So you go to the bank and say, okay, I'm receiving $300,000 in 3 months' time. I want you to give me the equivalent amount of that particular amount. So the bank will now borrow to you in the foreign currency. So they will be borrowing to you at 5.4. So you use this amount to find the amount that the bank will be giving to you today. So that if they charge the interest for 6 months, they will get a total amount that you are going to be paying them. Then you will take this amount in the USD now. You will not convert it because the bank will be giving you that amount. So you will convert it to your currency, which is the what? The pounds. Because you are going to be receiving the money in 3 months' time, you are going to be putting the equivalent amount also, which is this one, into a deposit, into a deposit, which will be the local currency deposit, and that will be attracting 0.46. So this is the amount that the company will be receiving if they are using the forward market. This is the receiving, not the amount that they are paying. The amount that they are paying the bank will still be the 300,000. All right.
Okay. Okay. So my question was the 535,485.26. That is the future value of the money that we are borrowing now. That will pay, which is equivalent to the 300,000.
No.
I don't know if I'm clear.
That is not the equivalent value of the 300,000. No. Okay. You are receiving 300,000 from someone in the US in 3 months' time. Okay. So I am into buying and selling of foreign currencies. Okay. I'm telling you that if I'm borrowing to someone in the foreign currency is 5%. Okay. what the meaning is that if you are receiving a 300,000 from someone in the States and you are coming to me, that, okay, you are receiving 300,000 from someone in the States. Indirectly, you are telling me that I should borrow you a certain amount of money so that in 3 months' time, using my interest rate, it should be equal to the 300,000 that I'll be giving to you. So you are receiving 300,000 from someone in 3 months' time. Okay, you can't wait for the 3 months' time because you don't know how the exchange rate will be in 3 months' time. So you just come to me. I'm into buying and selling of what currencies. And whenever I borrow using the foreign currency is 5%. Okay, so you are telling me now that you are receiving 300,000 from someone. And if you should go and borrow from somewhere, it is 5%. Okay. The question now is, if I want to give you amount today, if you are coming to me that you are receiving 300,000, if I want to give you amount today, the amount I should give to you should not be the same as the 300,000. Because I'm also there to make profits. The 300,000 that you are receiving is in 3 months' time. And you are coming to me that I should give you an amount. That's so that in 3 months' time, you receive the 300,000 and pay me. I cannot give you 300,000 today, no. Because the interest rate I'll be using is 5%. So it means that the value of 300,000 in 3 months' time is not the same as the value today. So I have to present value the amount I'll be giving to you or the amount that you'll be receiving. That is why we present value this amount to this particular amount. So I'll be giving you 296004 of the foreign currency. Okay, so you will now go and keep this amount in a deposit account, or you will now take this amount and change it to your local currency. So if the exchange rate is 5 CD, then you multiply this to know your local currency. Okay, so if you know the local currency, then you now put this amount on the deposit in the local currency for 3 months. And that's what we have done over here. So the company is putting the local currency over here on a 3-month deposit. This is not the amount that they will be paying. As soon as the bank has given this amount to us, we will now receive the 300,000 from the customer and give it to them. That's all. We will now receive, whenever the 300,000 come, we will now go and pay to the bank. We are going to be giving the 300,000 in the USD. Okay, but this is the amount that we will be getting in the local currency if we decide to use the money market. So the bank will borrow to you in the foreign currency. So whenever you receive the foreign currency, you go straight to the bank and pay them the 300,000. But the local currency that the amount that the bank has given to you, how did you manage that particular amount? You have translated it and put it on a local deposit. And what is the amount that you have earned on that particular amount that you have put on the local deposit? Okay. And that is the 5333. That's not the amount that we are paying the bank. We will receive the 300,000 and give the 300,000 to the bank. Adam, I hope I've made sense now.
Yeah. Now
Okay.
it's better.
You just have to manage it.
Yep. I want to get something clear. This doesn't mean that if the company is receiving, meaning they are going to choose the highest, the higher form of the translation, whether forward contract or money market. But if they are paying, they are going to take the lower amount.
No, if the company is the one receiving, if you are into forex trading, okay, if someone bring Ghana cedis to you that a person $1, if someone bring Ghana cedis that, okay, I want to change Ghana cedis to dollar, and someone is bringing dollar that the person want Ghana cedi, are you going to be giving it the same rate, the same exchange rate?
No, sir.
Okay, the person that is coming with the Ghana cedi for dollar and the person that is coming with the dollar for Ghana cedi, which of them will be having the highest rate? Which of them will be having the lowest rate?
I think that the person coming for the Ghana cedi will have the lowest rate.
Okay, and the person coming for the USD
will have the highest rate.
Okay. So if the bank is the one receiving the money, it means that they will go and sell the what? The foreign currency to the bank, isn't it?
Yes, sir.
So it means that the company is the one bringing the foreign currency for the local currency. So they will be selling at the lowest rate. Okay. But if it's the company that is bringing the local currency for the foreign currency, then the bank will be selling to them at the highest rate.
Okay.
All right. I've seen a
So
chart.
please, the calculation. You see, when we are done, we have to choose from the either forward market or the money market.
Yeah, the question will ask you whether they should use that one. So you choose the one. If you see that the company is the one receiving, isn't it?
Yes.
So if you are receiving, you pick the what? The highest one. But if you are the one paying, you pick the lowest one. So you have to be very careful with it. If it is cost, you pick the least cost. But if it is revenue, you pick the highest one.
Okay.
So this is a revenue. So the company will pick the forward one because this is revenue. They are receiving. Okay.
Okay.
Let me see. Someone is saying something. Please, I'm confused. Why would a company go and borrow an amount that they will be receiving now and then go and deposit? Why would a company go and borrow an amount we'll be receiving now? No, the amount they are receiving is not now. They are receiving the amount in 3 months' time. So we don't know what will be the exchange rate in 3 months' time. So we want to enter into what? Money market. Money market is a situation where you can buy and sell. So we are entering into a money market today. So if you are entering into a money market, the meaning is that the 300,000 that you'll be receiving in 3 months' time, you can't wait for the 3-month time. I don't know what will be the exchange rate at that time. So let me go to a bank and get the equivalent of the 300,000. So if I get the equivalent of the 300,000, then for the local currency, I can have control over it because I'm trading the local currency. So I will put the equivalent of that particular amount now. This thing will be done now before the 3 months. It is not a 3-month time that they are doing all these things. They are doing it now. So I cannot wait for the 3 months before receiving the 300,000 because the exchange rate might not be in my favor. So what I will do is that since I have control over the local transactions or the local currency, let me go to the bank and say, okay, I'm receiving this amount in 3 months time, but I cannot wait for the 3 months to come. So give me the equivalent of that amount at any equivalent rate that you are using. Then that particular amount, I will now put it on a deposit. I will now put it on a deposit with the bank in the local currency. So at the end of the 3 months, if I receive my 300,000 USD, I will give it to the bank and the bank will give me the money in the local currency. So the bank will give me the equivalent of that one. And at the end of the 3 months, I'll receive the 300,000 and give it to them. So what is the amount that the bank should be giving to me in the local currency? And that is what we have done. So it is not in 3 months that they are doing all these things. We are trying to manage the forward, the currency risk exposure. So you go to the bank and say, all these things will be done in 3 months' time. So give me the equivalent of this amount now. I will place that particular amount on deposit with you because I'll be paying you in 3 months' time. So the deposit will also be with you for 3 months' time. Then you give me the money in the local currency using the deposit that we have done, which will be 5333484.26. Then me, I will just give you the 300,000 USD. That is all. That is final. So I don't know whether I've answered your question, but so if I've answered your question, you can let me know. But then we should continue. Okay, Adam.
Should we go on to question 3?
Yes, please. Let's take the question 3.
Okay. Question 3. It is 30th June. The new company will need a 20 million pound 6-month fixed rate loan from 1st October. The company wants to hedge using FRA. The relevant FRA rate is 7% on 30th June. Required Explain how FREs work and state what FRE is required in this situation. B. Calculate the result of the FRE and the effective loan rate if the 6 months FRE benchmark rate has moved to 6% and 9% respectively. Yeah.
All right. So this is interest. This is interest rate risk. This is interest risk. Okay. So you can say the company wants what? The company will be needing what? 20 million in 6 months from October. Okay. The company wants to hedge using the forward rate arrangement. Okay, the forward rate arrangement, which is the same, it works like the forward contract. Okay, the forward rate arrangement rate is what 7% on 30th June. Okay. Required. Explain how the foreign rate arrangement works and state what one is required in this situation. Okay. So how does the forward rate arrangement, how does it work? How does it work?
Okay, so let me see if I can get it right. So my understanding is that you agree the rate today on how much you pay in the future date.
Okay.
Yeah.
Okay.
That's my understanding.
So what if in the future the rate has increased? So right now the rate that we are agreeing on is what? 7%.
7%.
Okay.
Yes.
But right now the rate has moved to 9%. Are you going to be paying the 9% or you still pay the 7%?
You still pay the 7%.
Okay. So you pay the 9% and the bank will make a refund of 2% to you. So if the rate increases, you pay and the bank will refund to you. If the rate decreases, you pay the additional amount. So you can see that the rate is now 6%. Okay, you'll be paying additional 1% to it. So if the rate reduces, then you now pay the what? The shortfall. If the rate increases, the bank will refund the what? The excess to you. That's how it works. So you are going to lock up an interest rate in a forward agreement. You are locking up the interest. But what if the interest increases in the future? You will pay, but the bank will refund the increased amount that you have paid to you. If the rate reduces, you pay for the actual rate plus the reduction. Because whatever be the case, the rate that you should be using should be 7%. The rate that you should be using should be 7%. Okay. Sometimes you have a rate that can be a borrowing rate that you will be borrowing. It can also be a rate that will be a depositing rate. So you will now be having they will be giving you a fixed rate if you want to receive. They can also be giving you a fluctuating rate. Okay, and they can also give you what we call a guaranteed rate. And this is what we call a guaranteed rate over here. You can see that they are guaranteeing you what? A 7% what? Interest. Whatever be the case, you'll be paying the interest at 7% for 6 months. Okay, so that is how it works. And B, calculate the result of the FRA and the effective loan rate if the 6-month FR benchmark rate has moved to what? Has moved to 6% and 9%. Okay, so let's now come here. How much is the company? How much are they going to be taking?
20 million.
Okay, for how many months?
6 months.
So what will be the interest under the agreement? It will be 0.07 times 20 times 6/12. Am I correct? Please, am I correct with the calculation? Please, is the calculation correct?
Yeah, it's 6 months.
Okay, so how much are we getting?
What's 0.7?
Okay, 0.7 million. Okay, so let's count to the interest under the what? The 6%. So the rate has now moved to 6%. That will be 0.06 times 20 times 6/12. How much are you going to be paying?
$0.6 million.
Okay, so this 0.6 million, the company will pay 0.6 plus what? 0.1 million. Whatever be the case, the rate that you'll be using is 7%. So the company, the actual interest that they will be paying will be 0.6. Then they will now add the shortfall to it. Okay, let's count to 9%. The interest under the 9% will be 0.09 times 20 times 6/12. What are they having?
0.9.
0.9, isn't it? Okay. So they will pay 0.9 and the bank will refund how much to them?
0.2.
Okay. So the bank, you pay the actual interest. If there's a shortfall, you add it. If there is an excess, the bank will refund the excess to you. That is how we go about it. So the effective interest rate are 6% and 9%. That is the actual interest for the period. Okay. So that is for that. Let's look at the okay. Let's pick some. Okay, let's pick some questions on the. At least let's see whether we can pick 2 questions on the investment appraisal. Then we move on. Okay, let's take the first question.
Okay, investment appraisal, question 1. Will you project it? I have it, maybe someone would like to watch it.
So it's not showing.
No, but I have the printout already, so I don't want to be reading when the screen is.
Is it showing now?
Yes.
Okay.
Okay, so Dioco needs to increase production capacity to meet increasing demands for an existing product, Kwego, which is used in food processing. A new machine with a useful life of 4 years and a maximum output of 600,000 kilograms of Kwego per year could be bought for 800,000 Ghana cedis, payable immediately. The scrap value of the machine after 4 years would be 30,000 Ghana cedis. Forecast demand and production of Kwego over the next 4 years is as follows. Year 1, 2, 3, 4. The demand is 1.4 million for year 1, 1.5 for year 2, 1.6 for year 3, 1.7 for year 4. Existing production capacity for Kwego is limited to 1 million kilograms per year, and the new machine would only be used for demand additional to this. The current selling price of Kwego is 8 cedis per kilogram, and the variable cost of material is 5 cedis per kilogram. Other variable costs of production are 1.9 per kilogram. Fixed cost of production associated with a new machine would be 240,000 Ghana cedis in the first year of production, increasing by 20,000 per year in each subsequent year of operation. DIOCO pays tax 1 year in arrears at an annual rate of 30% and can claim capital allowance, that's tax allowable depreciation, on a 25% reducing balance basis. A balancing allowance is claimed in the final year of operation. DIOCO uses its after-tax weighted average cost of capital when appraising investment projects. It has a cost of equity of 11% and a before-tax cost of debt of 8.6%. The long-term finance of the company on a market value basis consists of 80% equity and 20% debt. Required: A. Calculate the net present value of buying the new machine and advise on the acceptability of the proposed purchase. Work to the nearest thousand. B. Calculate the internal rate of return of buying the new machine and advise on the acceptability of the proposed purchase. Work to the nearest thousand. C. Explain the difference between risk and uncertainty in the context of investment appraisal and describe how sensitivity analysis and probability analysis can be used to incorporate risk into the investment appraisal process.
Is that all?
Yeah,
Okay, you can see that it's very simple.
but tricky.
Okay.
I think the last time we spoke about the production limits.
Okay. Let's take the question one by one. You can see that this one, they are asking you to for the present value, but they haven't given you what? The cash flow. So you have to determine the cash flow yourself, isn't it? Okay.
Yes.
All right, let's talk about this one. You see the company want to increase what?
We want to increase production capacity to meet the increasing demand.
Okay. And rain is worrying me here, so let me find a place and we continue. Okay, so how much is the is the cost of the new machine?
The cost
800,000.
800,000.
Okay, and what is the maximum output the machine can be able to produce up to what?
600,000.
600,000.
Okay. The machine has a scrap value of what?
30,000.
30,000. So the forecast demand and production of guaco over the next 4 years is as follows. Look at this place. These are the demand. Okay. But they say the existing production capacity for guaco is limited to 1 million kilograms per year. And the new machine will only be used for the demand additional to what? To this. So in the first year, the new machine will produce how much?
Additional 4 million.
400,000.
It will produce
400,000,
400,000. But you have to know that we are only appraising the new project, isn't it? So we are going to be looking at the returns that a new project will be bringing. You will not be using all the 1.4 because the 1.4 existing machine is producing 1 million. We want to know whether the new project is what is feasible. So we only be looking at the cash flows. So the first year, the machine will be bringing or will be producing 400,000 units or 400,000 kilograms. If you come to the second year, what will be the output of the new machine in the second year?
500,000.
Okay, third year will be what?
600,000.
And the fourth year will be what?
700,000. But you can't buy SC, so you still produce the 600,000.
Okay, so you only be taking the excess demand. You are appraising the new project. So you only look at the output of the new project or the revenue that the new project will be bringing. So let's now start our work. So we put our cash flow statement over here. So we start with our cash flow statements. Okay, a cash flow statement or statement of cash flow, anyhow you want to name it. So cash flow statement. So what we do is we have the years over here, then we have the 0, we have the 1, we have the 2, we have the 3, then we have the 4. Then you now put the items over here. So let me bring the years to this one so that I can put my items here. So the years will be here. Okay. So let me have the years here. Then I have 0. Okay. Then I have 1 here. Okay. Someone can prepare this like statement of profit or loss. So you bring your revenue, you take your cost from it, you find your contribution, your gross profits, you take your fixed cost from it, you take your depreciation, you charge tax, you add back depreciation because we are using cash flows. Someone can also decide not to bring revenue over here, and the person will just bring contribution. So the person will just do workings and bring only contribution. So let's come to the workings here. Okay. So the person can do workings 1. The person will say contribution. Okay. I'll be showing all the 2. How do we calculate contribution? So the person will have the years here. So the person will have the years here. The person will have year 1, year 2, year 3, and year 4. So let's put this here. How do we calculate contribution? Contribution is calculated as what?
Sales minus variable cost.
Okay. So the person will just do so the person will bring selling price here. The person will bring selling price here. Selling price is what? What is the selling price in the question?
Eight cities.
Okay. So
City.
every year is 8 cities. There is no inflation, so every year is 8 cities. Okay. You can see that these are all per unit, isn't it? So what is our variable cost? What is our total variable cost per unit?
5.
Plus other variable costs.
Up to 6.9.
Okay. 6.9. Okay, so 6.9, that will be a subtraction. 6.9, that will be a subtraction 6.9. What will be our contribution per unit? So the person
1.1.
So the person will bring the demand here. Demand will be 400,000, isn't it? 500,000. The person will bring 600,000 here. 600,000 here. So the person will now find the total contribution. So let's find our total contribution. What will be the total contribution each year?
$440,000.
Year 1, 440,000. Year 2, 550,000.
550.
Year 3, 660.
Okay.
And it continues.
Okay. So the person will just put it here like this. The person will just bring the contribution here. So there will not be any contribution year 0 because we assume that cash flows will be arising at the end of the year. So 440,000. 440,000. So 440,000. 550,000, 660,000.
Linus, they said we should work to the nearest 1,000.
We should work to the nearest 1,000. So if you have decimals, you just approximate it to 1,000.
Is that so? I thought you would approximate this one to thousands.
No.
Oh, okay.
You only do the decimals. If you have maybe 999 something, you approximate your answer to the 1,000.
Okay.
Okay. So that is the first. Someone can do it like this. Okay. Someone can also decide to bring the revenue one by one. Someone can decide to do workings for the revenue, where the person will be multiplying the unit by each of them and bring the revenue. Then the person will also come and find a variable cost. Then instead of you bringing a contribution, you bring revenue for each year. Then you bring a variable cost for each year. You see that if you subtract, you will still be getting the contribution. So anyhow you want to do it, that is fine. So the next thing will be the fixed cost. Okay. The fixed cost. So let me just put the yes here. So the fixed cost. What are the fixed costs that we have in the question? Sometimes the question will say that excluding depreciation, or sometimes they will say including depreciation. All right. Fixed cost of production.
240.
Fixed cost of production associated with a new production will be 240 in the first year of production, increasing by what?
20,000 per year.
Okay. So these fixed costs are excluding depreciation. Okay. We have two ways of looking for a depreciation, but for FM, the recommended way is what we are going to be doing. You see that we are looking for cash flow, not depreciation. Someone can decide to include a depreciation to now, because the tax authority will give you capital allowance on the depreciation. So you separate the depreciation from the profit, then you now charge the tax. After getting the figure, then you now add back the depreciation. But what we do in FME is that we exclude the depreciation as assuming we are paying tax on the depreciation. Then we now calculate what we call a tax benefit on the depreciation. Okay. So what we do is that the first year, our fixed cost is what?
240.
Okay. Every year it will be increasing by what?
20,000.
Is it 90 or 20?
20.
20.
Okay. Please don't say that it will be 260 for the remaining 3 years. No. Every year is increasing by 20,000. That is the meaning. So 240, this 240 will increase by what? 20,000. 260 will increase by 20,000. 280 will increase by 20,000. That is the meaning of it. So it will be increasing every year by what? 20,000. So every year's figure will be increasing by 20,000. That is what they actually mean. Okay, let's come here. So we are done with the fixed cost now. So the dual could pay tax 1 year in arrears at an annual interest rate of 30% and can claim capital allowance or a depreciation on a 25% reducing balance basis. A balancing allowable is this one. So what we are coming to calculate is the tax benefits. So let's calculate our cash profits. This will be 200,000. So let's look at cash profits before tax. Cash profit before tax. Okay, so you can see that tax is paid in arrears. So we are going to be having additional 1 year here. Okay, so that will be dash. Okay, let's come to what will be a year 2. What are we having?
The 290.
2 what?
290.
Okay.
290,000.
290,000. Year 3 will be what?
380.
380. Okay, this will be 360. Okay. Let's now calculate our tax. Okay, tax will be calculated on this figure. So let's calculate our tax now. What is the tax rate?
30%.
Year 2.
The tax for year 1, 30% on that one. What are we getting?
So okay, I did for
60,000.
It's 50,000, isn't it?
60.
Okay, let's look at what they are saying here. Let's look at what they are saying here. They say copay, the due copay tax 1 year in arrears and at annual interest rate of 30%. So it means that the first year's tax will be paid in what?
Year 2.
Okay.
Yeah, in the following.
So this will be 60,000 here. What will be the tax in the
87,000.
60?
87.
Okay.
114.
114. And year 5 will be what?
108.
108,000. Okay. So you can go ahead and have your cash profits after tax. Okay. So you see that this will be 20,000. This will be 230,000.
$293,000.
293,000.
$246,000.
246,000. And this will be 108,000. Okay. Okay, you have to, the first thing that you have to know is that you can see that the tax authority is giving a capital allowance on the what? On the asset, isn't it? Okay.
Yes.
Since they are giving capital allowance on the asset, what we have to do is that depreciation must be, the capital allowance must be subtracted from the profit before we charge tax. But you can see that we are not taking depreciation or capital allowance from the profit before paying the tax, isn't it? So we are paying the tax on the what? On the depreciation amount too. So we now ask ourselves, what is the portion of the depreciation? What is the portion of the tax we are paying on the depreciation? We should have paid that one in the first place. So the tax over here, they are also including an amount of tax that we should not charge on the depreciation. So we do what we call tax savings. How do we do the tax savings? This is how we do it. So we now be looking at tax benefits, or some people call it tax savings. That is a portion of the tax that you are paying on the depreciation, which should not be paid. So you go and add it back. Okay, so we look at the years here. We look at the cost, we look at the depreciation, and we look at what we call the tax benefits.
Every week, Kenya,
Please a minute. Okay, so let's look at the years here. We have year 1, year 2, year 2, year 3, year 4. Okay, what is the cost of the, what is the cost? What is the cost of the instruments?
800,000.
800.
Please, what we have to know is that the tax authority does not calculate depreciation like how the company do calculate their depreciation. No. Okay. So the cost is 800,000, isn't it?
Yeah.
Okay. How much is the depreciation every year? How much is the depreciation for the first year rather, not every year?
25%, reducing balance.
Okay. So let's calculate the depreciation for the first year. %25 on 800,000. What are we getting?
200,000.
Okay. 200,000. Okay. The meaning is that this 200,000 as a depreciation should have been taken from the profits over here before we charge our tax. So the 200,000 should have been taken over here before we charge the tax, but that has not been taken. The meaning is that no tax should be paid in the what? In the first year, because the profit will be 0. So what we do is that we haven't subtracted the 200,000 and we are charging what? The 25, the tax rate also on that particular 200,000. So the question is, what is the tax portion that we are paying on this amount? So we multiply the depreciation by the tax rate. So multiply by 0.3. That will give us 60,000. Is that correct?
Yes.
Okay. Look at this place. Assuming we are taking, you can see that the fixed cost is excluding depreciation, isn't it? Okay. Assuming we are taking the depreciation from this year, we are taking the depreciation from the profit. You see that the cash profit over here will be 0, isn't it? If we are adding 200,000 to this, you see that the fixed cost will be 400,000 and the profit over here will be what?
0.
Will be 0, and we'll not be paying any what? Tax. Okay, we'll not be paying any tax in this year. So what will happen is that we will not pay any tax in this year, and the profit will also be 0. Then what we come and do is that we come and add the depreciation back to it, because depreciation is a non-cash item. But we haven't done that. So it means that we are assuming that we are paying tax on the 200,000, which is the depreciation too. So what portion of the tax we are paying on that? That is what we are going to be reversing. So the first year, the tax that will be reversing will be 60,000. That is the first year. Okay. We are doing this on reducing balance basis. So depreciation is what? Is 200,000. It means that this place will be 600,000. Am I correct? We are doing it on a reducing balance basis. So it will be on the net book value every year. What will be the depreciation on that? 20% on 25% on that.
150,000.
150,000. Okay. What is the amount of tax that we have charged on that?
45,000.
$45,000. Okay.
Yeah.
Let's come to what would be would this be 450,000?
Correct.
Okay. And the depreciation on it will be what?
112,500.
Okay, 1125. What is the tax that we have calculated on it?
33,750.
Okay. What will be the amount at the end of the year 4?
$337,500.
Okay, but this particular machine will be sold at the end of the 4 years, isn't it?
Yes.
Okay, if you sell it, you are going to be paying tax. So the question now is, the tax authority will be giving you a tax on the 33700 because we don't calculate depreciation because the machine will not be used elsewhere. So they will just grant capital allowance on the full amount. So you'll be enjoying capital allowance on the full amount, whilst you also be paying tax on the 30,000. So the question is, we just look for the net tax that you'll be enjoying. So the tax authority will give you capital allowance on the full amount over here. So they will allow you to subtract the full amount from the profits because the asset will not be used elsewhere. So they will give you the tax benefit. So you don't calculate depreciation on this. You only calculate depreciation on this when the question says that the asset will be used elsewhere. The asset will be used elsewhere. So it means that you use the asset 4 years over here. Then you go and use the remaining carrying value elsewhere, where you'll be claiming capital allowance on it. But this one, the asset is not going to have any other use. So the tax authority will always give you capital allowance on the full amount. So that will be 0 points. This one, they will give you the tax benefit on the full amount. So you apply it on the full amount. I want to show you something. What are you getting? You don't have to charge depreciation on this one. Okay, we take this full amount as the depreciation for that year. What are you having? I'm having
101,250.
Okay. But what will happen is that you also be paying tax on what? On the proceeds. If you sell the assets, it will be taxed. It will be taxable. Okay, the gain on the asset will be taxable. And you are paying
9,000.
Okay. 9,000. Okay. So what is the net amount that you are enjoying?
$82,250.
Okay. 922 what?
50.
Okay. So what we normally do is that you'll be enjoying benefit on this and you'll be what? Paying on this. So the question now is, what is the net amount, the net benefit? So we always subtract the residual value from what? The last figure before granting the what? The total amount on that particular one. So you just subtract the 30 from this one. 337,500 minus 30,000. Okay, so you just put your 37,500 over here, the same amount over here, then you charge the capital allowance on it. That will give you the same amount that you have gotten there. So multiply by 0.3. You can see that it's saying 92250. So we find the net benefits. We find the net benefits. The last year, don't calculate the capital allowance before you calculate the tax benefits. You only do that if the question says that the asset will be used elsewhere. Okay. How is the tax being paid? The tax is paid 1 year in arrears, isn't it?
Yes.
So you also claim the capital allowance based on how the tax is being paid. So the year 1 will be sent to year 2. So you now count to tax savings. We normally name it tax savings. So you can put the workings there as workings too. Okay. So the first year will be dash. This will be what? 60,000, isn't it? $60,000. Then we have 45,000. Then we have what? Year 4 will be what? 33,750. And no, this will not be a reduction. It's supposed to be addition. Okay. Because this is, so we add back. This is the amount of depreciation that is included in the tax. So we add it back by neutralizing the effect on that. Okay, let's come to the last year. What are we having at the last year? We have 922. 922 what? 50. Okay. So we now bring what? Some items again. We now bring other cash flows aside the normal cash flows that we are going to be receiving from production and other things. There will also be other cash flows. Okay. So other cash flows will be the residual value. Okay. What is the
Linus,
residual? Yes, please.
the last year, which is the year 4,
Yes, please.
so the how do we call it? The 92250
Yes, please.
is supposed to go under year 5 or year 4.
We claim the capital allowance in the manner in which the tax is being paid.
Oh, okay.
Yeah. Okay, so that the residual value will be received at the end of the 4th year. The residual value is also another form of cash flow. Okay, so what we do now is that we bring the initial investments. So we bring the initial investment. If there is any working capital, you bring it. The initial investment will always come under the year 0, which is now. Okay, so you have dash, 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 dash here. So you can now you can now total your cash flows based on what we have. I don't think there's any other cash flows that we have to bring here. Okay, is the residual value, which is 30,000. I don't think there's any other. There is no. So they say a balancing allowance is claimed in the final year. That is what we have done. Due to this one, the company used after tax cost of capital of this. Okay, let's now bring our cash flows. Let's add them. Please put them together. Let's put them there and present value them. So I'm going to be having 80,000 over here as, okay. Then we have 20,000 here. Would this be 290,000? That will give us what? Year 3 will give us what?
$338,000.
Okay. 338,000. Okay, year 4 is what?
309,750.
33.
309,750.
Please mention it again.
309,750.
Okay. And the last year will give us what?
The negative figure, so 15,750.
15,750. All right. So what will be the discount factor? We have to calculate the discount factor also, isn't it?
Yes, please.
Okay. Yeah, I said the company uses what? The company uses what?
After tax weighted average cost of capital when praising investment rate. Cost of
Okay.
equity of 11%.
Okay. How do we find
Before tax cost of it?
how do we find the how do we find cost of capital? How do you find weighted average cost of capital?
It's just your equity plus debt.
Please, I can't hear you.
It's the equity plus the debt.
The equity plus the debt.
Yes, please. But for the debt, you take into consideration of the tax.
Okay. Adam, do you have anything to say?
Oh no, he's right. So you just find the work and then.
He's right.
So 11%, then they've given us the, how do you call it, the equity and then the debt. So 20 and 80. So we have 80 over 100 times the 11%, which will give us our equity figure. And then the debt will be 8% minus the tax times 20 over 100 give us the cost of the debt. The two give us our cost of capital, the work.
Really? Really?
Yes.
Okay. Okay. So our work is calculated as VE over VE plus VD multiplied by KE, isn't it?
Yeah.
Plus VD over VE plus VD multiplied by what? KD into bracket 1 minus T, if you are given the before cost of debt. Okay. Before that's cost of debt. So what is the proportion of these two items? How is being financed? The long-term finance of the company on a market value basis consists of 80% equity and what? 20% debt. So you just come here, you can decide to write 0.8, but you can take them 80 over 80 plus 20 multiplied by the cost of equity is what?
11%.
11 what?
Percent.
Okay. Plus 20 over 80 plus 20 multiplied by, what is the before tax cost of debt?
8.6.
8.6.
8.6. So we have 8.6 into brackets 1 minus 0.3. Is that correct?
Yes.
Okay. So 80
Getting
over
6.02.
100 times 11% plus 20 over 100 times what? What are you getting?
6.2.
6.2.
6.02. 02.02.
Okay. So put all of them together and so put all of them together.
Linus,
Yes, please.
when you come to the debt, you made it 20 over 80.
20 over 100, sorry. Thank you.
You're welcome.
I'm getting 10%.
In total.
Yes. The first one is 8.8. The second one is 1.204. So the
Okay.
total is 10%.
So our discount factor will be 10%. So you now discount this cash flow using the 10%. So 0.909. So you just put them like that.
Perhaps now I'm paying no questions.
0.8.
Please, can you give me the discount factors?
Okay. So from year 2, 0.826,
0.826.
826,
Okay.
0.751 year 3,
Okay.
0.683 year 4, 683,
Okay.
and then year 5, 0.621.
Okay. So let's get them and move on. Find the present value of the cash flows now.
Year 1, 181, 800.
181.
800. Year 2, 239, 540.
23.
239, 540.
Okay.
Year 3 is 253, 838.
838.
253. 838.
83.
Mm.
Next one is 211, 559.25.
Two one one 559.
211.
559.
559. Okay.
5.
9780.25.
9780.
0.75, sorry.
97.
The other one has, yeah. The other one has 25. The year 4. It's supposed to 0.25. And then the last one is 0.75.
So mention it again. 97 what?
9780.75.
9780.
0.75.
Okay. Okay. Fine and see whether the NPV is positive.
Yeah. It's a positive NPV.
Okay. What are they asking again? They're asking you to calculate what?
IRR.
Okay. So we have used 10%, and what is the positive NPV that we have gotten?
76,956.5.
26,009 and what?
56. 76.
Okay. Mention it again. 2.
76956.5.
76956.5.
0.5.
Okay. So now they are asking us to find their RR. You can see that we use 10% and we have gotten 76956. So what rate are we going to be using?
Higher rate. Let's say 20.
Okay. You can maybe, if you use a 20, you can still be getting positive. So you can decide to
20.
You can decide to use 25. Okay. So what we do
Okay.
is that we have the cash flows already. So you have the years, the cash flow, the discount factor, then you have the PV. So you can make it 25 here or 20, still 20. So you come to the year zero. Year zero, you'll be having the 800,000. Then you have 1.00. You'll be having 800,000. Okay. Then you come to year one. The cash flow for year one was 200,000. So you put a discount factor at 25%. Year two, the cash flow was 290,000 before we discount. Year three, the cash flow was what? 3,330. That particular figure. In year four, the cash flow was 309750. Then you come to year five, then you have a negative 750. So you now discount them using the 25%. And if you get a negative, then you now calculate the internal rate of return. We calculated that, or we used that yesterday when we were doing our cost of debt. Okay, that was last 2 days. Okay, so if you get a negative over here, your internal rate of return will be equal to the lowest rate plus the NPV of the lowest rate, which is the A, over the NPV of the lowest rate plus the NPV of the highest rate. Okay, which will be the B. Then all multiplied by the highest rate, which will be the LB minus the lowest rate. So let me change this one to the LA. Okay, that is how we find the internal rate of return. Let's pick another question then.
Are you not doing the C?
The C says what?
Explain the difference between risk and uncertainty in the context of investment appraisal and describe how sensitivity analysis and probability analysis can be used to incorporate risk into the investment appraisal process.
Okay. Explain, let's move on.
I forget.
Okay, I've also forgotten. Someone should help us with the risks and the uncertainty. Risks and uncertainty, what does it mean? Who is helping us?
Please let me try.
Okay.
Yes.
Risk is a situation where the outcome of the event will be unfavorable. That's negative.
The risk.
Yeah, or- Uncertainty is when the outcome of the event is unknown. So it can be either positive or negative.
The uncertainty.
Yes, please.
Adam,
Yes, sir.
you say you have forgotten. Okay, thank you, Ma. You have done well. Sinashari, what do you mean by Sinashari, what do you mean by risk and uncertainty? Hey, Sinashari, you don't want to talk. Okay, so you have smartphone, go and search for it. It's not calculation. So just search for it and you'll get it. Okay, let's take the last one, the second question. Adam, take the second one for us. Adam, Adam, are you there?
Linus, I read.
Okay,
Bella Cosmetics, DC, is considering the launch of a beauty product called Zinco, which would last 4 years. Following information has been gathered in this regard. DC will need to spend 250 million on purchasing and installing the plant with a useful life of 10 years for the manufacturing of Zinco. At the end of year 10, the plant's resale value is expected to be 65 million Ghana cedis. The plant will be subjected to accounting per tax depreciation at 25% using the reducing balance method. DC estimates immediate working capital requirement to be 75 million Ghana cedis. A 15% increase, inclusive of inflation, in the working capital requirement that is based on the previous balance is anticipated at the start of years 2, 3, and 4. However, only 60% of the working capital is expected to be realized at the project's end. The remaining balance would be written off as unsellable inventory at the end of year 4. Sales of Zinco are expected to be 30,000 units per annum, remaining constant over a 4-year period. The selling price is estimated to be 4,000 Ghana cedis per unit. raw materials requirement for the year, along with current inventory details, are as follows. So we have the raw material details down there.
Okay.
NP will not be available in the market until the end of the first year. Further, it is also used in another product requiring 600 kilograms for the year. However, that product will be discontinued at the end of the year. SB is not used in any other product and can be sold in the market at 50% of its cost.
Okay. I should go
DC,
for. Okay.
estimates an annual labor requirement of 30,000 semi-skilled labor hours at 150 per hour and 10,000 skilled labor hours at 250 Ghana cedis per hour. The annual fixed cost, excluding depreciation, is estimated to be 1.8 million Ghana cedis. The applicable tax rate would be 30%. Taxes will be payable or refundable in the year in which the tax liability or asset arises. All revenues and costs are quoted in today's rates. Annual inflation is estimated to be 11% and will apply to all revenues and costs, except where specified from the first year onwards. SC's cost of capital is 22%. Required: compute A, net present value of Zinco, B, internal rate of return of Zinco, and advise whether SC should introduce it.
It's too plenty.
A lot.
It is well.
So this one is a Pakistan question.
Yes, please.
I thought as
Why?
much.
Why do you ask?
No, because it's loaded, very loaded.
Okay. No, it is well. It is well. Okay, so we take it one by one and we move on. Okay. So what do we have there? Okay. So the company is planning to what? To launch a new product that will last for what? 4 years. Okay. This will, we need to spend 250 million on purchasing and installing the machine with a useful life of 10 years for the manufacturing of zinc. So what is the purchase price of the machine that we are using? What is the purchase price of the machine that we'll be using?
250 million.
Okay. Okay. So we'll be using 250,000. Okay. But what we have to do is that we have to be very concerned with the cash flows first. Okay. At the end of year 10, the plant's resale value is expected to be 65 million. The plant will be subjected to accounting or tax depreciation at 25% using the reducing balance method. Okay. The company estimates immediate working capital requirement of 275 million and a 15% increase inclusive of inflation in the working capital requirement based on the previous based on the previous balance is anticipated at the start of year 2, year 3, and 4. However, only 60% of the working capital is expected to be realized at the project's end. The remaining balance will be written off as an unsellable inventory at the end of year 4. Okay. Sales of zinc are expected to be 30 units per annum, remaining constant over a 4-year period. The selling price is estimated to be 4,000 per unit. Okay, raw materials for the year along with current inventory details are as follows. So we have done that one also, and we have given information on that. We have given information on this one. So this one, what we can do is we can start with contribution. So this one will not start with contribution, but we start with, so let's bring the cash flow statement here. So let's bring our cash flow statement here. Okay, so what we do is that we bring the years here. So we have 0, we have 1, we have 2, we have 3, and we have 4. So the first one is we bring the revenue here. Again, this will be dashed. So let's go and do workings for the revenue. So let's do workings for the revenue. So workings 1 will be revenue. So we put the revenue here. Then you put the years 1, 2, 3, 4. Okay. The question is saying that the question says something about inflation there. Okay. They say that all revenues and costs are quoted in today's what? Rate. Annual inflation is expected to be 11% and we apply to all revenue and costs, except where specified from the first year onwards. So all the cost for revenue, all cost and revenue are in what? Current terms. So it means that the revenue price over here, the unit price over here, which is 4,000, is in current terms. So what do? We have to find the price at the end of every year. How do we find that one? We use the future value formula. So future value is equal to 1 plus R exponent n. So the first year, it will be 4,000. So I don't have to show it. You can just write the formula somewhere and say that that is how it has been calculated. So the selling price will give you 4,000. Or let me just shift this one small here and get the prices. Okay. So year 1, year 2, year 3, and 4. So I can say that this is calculated as 4,000 into bracket 1.11 exponent 1. So I can say this is calculated as 4,000 into bracket 1.11 exponent 2. So this will be calculated as 4,000 into bracket 1.1 exponent 3. 4,000 into bracket 1.1 exponent 2, exponent 4 rather. So that is how we are going to be calculating this one. So you look at the demand for each year. What was the demand given in the question? The demand is supposed to be 30,000 per annum. So 30,000. So you count to 30,000 here, 30,000 here, 30,000 here, 30,000 here. So let's get the values and send it there as revenue. Okay, then you count to the cost. You count to the second one will be the cost, the variable cost. Okay, the variable cost, you look at the cost price for each year, and let's look at what they are talking about there. Okay, so the variable cost, we'll be doing it for labor and those. Okay.
Hello.
So yes, please.
The growth in the inflation rate, I think it's between 1.11
Yeah, I wrote 1.11, isn't it?
Yes, please.
The inflation rate is 11%. So it will be one plus R. So the R is 0.11, which is 11%.
Oh, okay. Using the fishes. Okay,
Okay.
I get it.
All
Thank
right.
you.
All right. So let's look at the cost now. Okay. Let's look at the cost. So the cost, we calculate it for each of the material one by one. Okay. What is the material cost? What is the material cost for BW? What is the material cost for the BW? So let's calculate it one by one. Okay. So what is the material cost? The material cost for, okay, let's calculate the revenue first. Then we send the revenue there. We know that we are done. Okay. What are we having? Please, can we calculate the figures?
$132 million.
Keep 3 zeros.
Okay, then 132,000.
Okay. This is what I'm getting. 133,200.
Okay, let me check again. Okay. I missed one.
133,200.
133. It's 11%. Okay.
I'm
So
getting
147,852
147,852.
for the year 2.
Okay. Let's go to year 3.
The year 3 is 164,115.72.
Okay. 164,
115.72.
115, 115.72. Okay. Last one is what?
You get 182, 168,
182,
168.45.
45. So since we have this now, let's go and put it under the revenue before we come to the cost. So we have 133. So let me put the currency sign here. Right. So we have the revenue to be 133,200. Okay, the second one is what? 147,852. 147,852. Sorry. Nothing should be under here, 0. So dash 133 200 147,852. Okay. Year 3 is what? 164
164 115.72.
115.72. Okay, the last year
182
1
168.45.
168.45. Okay, so we now go to material cost. Let's come to the material. The material, we do the first one. What is the cost for the first one? The material BW, what is the cost? Can you see the
550 per
Okay,
kilogram
five.
for.
So what we do is it will be 550 into bracket 1.11 exponent 1, isn't it? 55 1.11 exponent 2. 55 1.11 exponent 3. 555 1.11 exponent 4. What I will do is I will just do all the workings, then you complete the things yourself. So 1.11 exponent 3, exponent 4 rather. Okay. Let's go to the material that we will be buying. Okay. Let's go to the demand now. Okay. You have to pay. This question is including MA and FM. You have to pay attention to something. What is the annual requirement? What is the annual requirement for zinc? What is
3,000.
that is the material that we are going to be using. It's not per kilogram. It's not 3,000 per kilogram. This is the total material that we'll be using for the 30,000 units. So it's not per kilogram. It's not per kilogram. That is the total amount of raw materials or total unit of raw material that we'll be using for the production of the 30,000. The 3,000 is not per kilogram that you have to be multiplying by the 30,000. No. Per kilogram is, we are going to be using 0.1 per unit. So 0.1 per unit. So that if you multiply the 0.1 per unit, you'll be getting your 3,000. Okay. So this is the annual demand. But what is the current inventory that we have?
1,500.
Okay. The current inventory has been purchased already, isn't it?
Yes.
Okay, it has been purchased already. So the 1,005, we are not going to buy it. So it will not be part of the cash flow. We use relevant cash flows. We use future cash flows. We use incremental cash flows. We also use opportunity costs. The 1,005 is already purchased. So if you count the relevant costing, that particular item has already been paid for. So it will be treated as a past cost. But what we need to buy additional one. How much do we need to buy?
1,500.
So we bring only 1,500 to the first year. Okay, so we pay for only 1,500. We do this one based on relevant costing. We use relevant cost. 1,005 has already been purchased. Whether we want to produce or not, it has been purchased. It's not part of a cash flow. It's not a future cash flow, but we have to pay for the 1,005 now as a result of this particular one. But the subsequent years, what will happen? We'll be buying 3,000, isn't it? Okay. For the subsequent years, we'll be buying 3,000. So we'll be paying for them. So they will be treated as what? As a future cash flow. Okay. All right. So you find their cost one by one. Let's go to the second material. So the second material will be, what is the second material? Is XB. Okay. So we come to material XP. Okay. What is the cost price?
4,200.
4,200. Okay. So this is also in current terms, isn't it? Okay. So you do 4,200 into bracket 1.1. Then you do 4,200, 1.11 exponent 2, 4,200, 1.11 exponent 3, 4,200, 1.11 exponent 4. Okay. Let's now come here. You have to be very careful with this. This is investment appraisal techniques involving relevant costing issues. Okay. Current, what is the annual requirement for SB?
1,200.
What is the current inventory that we have?
1,200.
Do you have to buy for this year?
No.
No. Unless the question says that the inventory are in regular use. So if you use it, you have to replace. So it means that year you have to pay for all of them. Okay, so if you use it, you have to replace them. Okay, so it means that we already have the 1,200, so we are not going to be paying. So there's no cash flow arising from this particular purchase. We have purchased it already, and that will be treated as a sunk cost, unless the question says that it is a material that is in a regular use. So if you use it, you have to replace it. So we use the replacement cost. Okay, let's come here. XB will not be available in the market until the end of the first year. Okay, it will not be available in the market at the end of until the end of the first year. So it means that you can't get SB in the market to buy until the end of the first year. Further, it is also used in another product, requiring what 600 kilograms for the year. Okay. However, that product will be discontinued at the end of the year. That product will be discontinued at the end of what? The year. Okay. SB is not used in any other product and can be sold in the market at what? 50% of its cost. Okay. So they are currently saying that the SB, it will not be available until the end of the first year. So it means that you can't get it in the market and buy. You can't get it in the market and buy. But the current 1,200 that we have over here, we are using 600 for what? We are using 600 for another product, isn't it?
Yes.
Okay. Look at the contribution. Contribution, if used on other products, what are you having for SB?
1,500.
So it means that if you are using the 600 for that, if you are using 600 on the other products, it will be giving you a contribution of 1,500 per kilogram, isn't it?
Yes.
But if you want to use it for this one now, will you be getting the contribution again? If you want to use the 600 on the SB now, are you going to be getting the contribution on the other products?
No.
Okay, so the contribution loss will now be opportunity cost over here, because we have to use the SB and we can't get it in the market. So what we have to do is that we have to take it from the other product that we are using, and the product that we are using it for, we are getting 1,500 per every kilogram if we use it. Now we are not using it. It means that 1,500 will not be getting. Why are we not getting the 1,500? It's as a result of we transferring the 600 from that place to this place. So the contribution loss will be, which is an opportunity cost. So the contribution loss will be the part of the cost for the first year. So that will be 1,500 times 600. What are we getting?
$900,000.
Okay, 900,000. That is part of the cost for the first year. So to be the contribution loss. We are using only 600. Remaining what? Remaining additional 600, isn't it? we have 1,002. So if we use 600 on other products, it will be remaining what? Additional 600, isn't it? It will be remaining 600 again. All right. However, that product will be discontinued. So we do this particular transfer will be made for only this year because we will not be producing that product again. Okay. But this year we have to produce. So if you want to transfer the 600 from that place, it means that the contribution that the 600 will be given to you over there will be lost. Why are you losing that particular contribution? It's as a result of the SB, you producing the zinc, Okay. SB is not used in any other product and can be sold in the market at 50% of its cost. Okay. Currently, what is happening? The SB is not what? It's not used in any other product. So if you are using the 600 for the other products, the remaining 600 will not be used for any product. But however, the remaining 60, the 600 can be sold at what? 50 of its cost. So let's now come here. So the remaining 600 kilogram, we have 1,002. We have 1,002 now. We are using 600 on this one, on one product. The remaining one will not be used in any other product, but we can sell it at what? 50% of its cost. What is the cost? What is the cost?
4,200.
Okay, 50% of it is what? 2,400, isn't it?
Yes.
So if you are selling the 600, what are you going to be getting? If you are selling it, what are you going to be getting?
$1,260,000.
Okay. So net realizable value will be 4,200 times what? 600. We are getting 1 million what?
260,000.
Okay. So 4,200 times 600. I'm coming in. 4, 2, 9, 6. Are you sure? I'm getting 252.
Hold on.
252. $2,520,000. Can someone
This one, how do you call it? The 4,200, the 50% will be 2,100.
It will be 2,100. Oh, sorry. So it will be 2,100. Okay. So if you multiply divided by 2, okay, 126,000. 1,260,000, isn't it?
Yes.
Okay. But if you are not using the 600, you will be getting this amount. But the 600, are you going to be selling it or you will now be using it? Will you be using it on the product, on the project, or you sell it? You have to know that they say that the SB will not be available until the end of the first year. So MB, the SB, you cannot get it in any market. It is the available one that you have that you can use. And the available one, if you are using it on a different product, you are getting a contribution of 900,000. If you don't want to use it, you want to sell it, the remaining 600, you'll be getting what? 1,260,000. So if you want to use it now, it means that you will not be getting this contribution and you will also not be getting this amount. So the cost that you'll be putting for the first year will be the addition of the two. Let's add the two and see what we are getting.
$2,160,000.
2,160,000, isn't it? Okay. But they are saying that all revenue costs are in their current terms. So this one you have to increase it by. So year one, I can just take the year one off over here and bring this to 160,000. Then I will increase it by 1.11 because all these calculations that we have done, they are in current terms. So you can decide to multiply this by 1.11 by increasing it by year. So you also multiply this one also by 1.11. You'll be getting the same answer like doing it like this. So the figure that you are going to be using for the first year will be the loss, the opportunity cost that will be coming as a result of you using the 1,200 on the new project. If you don't use the 1,200, you'll be using 600 elsewhere, and you'll be getting a contribution of 900,000. If you are using it on the project now, it means that that contribution, you will not be getting it. So that is an opportunity cost. If you are not using it and you are using the 600 elsewhere, it means that you'll be getting a contribution of 900,000, and you also be selling the 600 to a different person and be getting a net realizable value of 126,000. Now, the SB will not be available, so you don't have any choice than to use the current one that you have. If you are using it on the project now, the amount that you'll be getting from selling and the contribution, you will not be getting it. So those will now be the what? The cost for the first year. That will now be the opportunity cost for the first year. So if you come to the second year now, you will now start buying them. So the demand for the second year, this will be dashed. The demand for the second year will now be 1,200. 1,200. Okay. So the technical side of the question is just the figure that you'll be using for the first year. Okay. So you get that one too. Then we can now move on to another issue. So it's not something that is really difficult. It's not something that is really difficult, but how to break down the technical issues over here. So we are done with the sales. We are done with the material cost. Let's come to labor. So that we add the labor and then the material cost to have the total variable cost. Okay, let's now come here. The company estimates the annual labor requirement of 30,000 semi-skilled labor hours at 150 per hour, and 10,000 skilled labor hours at 250 per hour. So you can say the company will be using what? The company will be using two type of labors. Okay, so let's find their cost one by one. Let's find their cost one by one. Okay, they have given you the total labor hours requirements. So let's look at the labor cost. So you have the semi-skilled. Semi-skilled. Okay. So you have the semi-skilled. I hope you are not getting confused. Even if you are getting confused, just manage it. It is normal. Okay. Let's look at the cost per hour. So semi-skilled is how much? It's 150, isn't it?
Yes.
Okay, but this is in current terms. So what do we do? What do we do? We do 150 into bracket 1.11. 150, 1.11 exponent 2, 150, 1.11 exponent 3, 150, 1.11 exponent 4. So you count to the hours, it's 30 hours. So you just multiply your inflated answers by this one. Then you get the labor hours for this. Let's go to the skilled labor. The skilled one. The skilled labor. Let's look at their cost. What is their cost per hour? Is 250. Okay, their cost per hour is 250, which are also in current terms. Sometimes they will just give you the 150. They will not say they are in current terms. So if they give you the 150, they don't say they are in current terms. So what we do is that we don't inflate the first one. We assume that the 150 is the price at the end of the year. So the inflation will start from the next year. But if they say they are in current terms, it means that they are giving in today's value. So you have to start the inflation from 1 year, the first year. But sometimes they will just give you the first year value and they will give you the inflation rate. You assume that the first year value is estimated at the end of the year. So the first year value, nothing will happen to it. You will start inflating from the next year or the second year. You have to take note of that. So that will also be 250, 1.11, 250, 1.11 exponent 2, 250, 1.11 exponent 3, 250, 1.11 exponent 4. Then you count to the requirement now, the hours required. This will be 10,000 hours, 10,000 hours, 10,000 hours, 10,000 hours. Then you multiply and get your answer. So you put the two material costs. You find this, you find this, you find this. Okay, you find them, then you put all of them as a variable cost. So that will be the variable cost that you'll be taking from. So that will be the variable cost. So you put all of them together and have your variable cost. And that will be subtracted from your revenue to get your contribution. Then let's come to the fixed cost. The fixed cost. Okay. So the annual fixed cost, excluding depreciation, is estimated to be 1.8. What is going to happen is that mostly you'll be doing the tax benefits. You'll be doing the tax benefits. Okay, you'll be doing the calculation for the tax benefit and be adding it. So what you do is that whenever the question says that depreciation is included over here, you have to calculate the depreciation on the normal way that the company will be calculating depreciation and take it from the fixed cost. So you always have to do the calculation for the depreciation, take it from the fixed cost, because we want to use the tax benefit approach. We want to use the tax benefit approach. So the fixed cost every year is what? Fixed cost every year is what? Please, are we here?
1.8 million.
Okay, if we are keeping 3 zeros, that would be 1,800, isn't it?
Yes.
Okay, so each year what you do is that you have to, this is in current terms. So the cost, that will be 1,800, 1.11, 1,800, 1.11 exponent 2, 1,800, 1.11 exponent 3, 1,800, 1.11 exponent 4. So that's how you do it. Then you, after getting the fixed cost, then you go and subtract it from your contribution. Now you get your cash profits. So after getting the cash profit, then you now apply your tax on it. So you find the tax, like the way we did the first one. Okay, so that will give you the fixed cost. You get a fixed cost and go and subtract it from, like the way we did this one. Okay, so you subtract the fixed cost and get a cash, so you calculate the tax, then you get your cash profit after tax. From that place, then we now start with the tax benefits now. Okay. So the annual fixed cost, we are done with that. All revenue and this one, we are done with that. Let's come to the tax, the depreciation. Okay, so we have to do the depreciation. Then we also have to come to the working capital requirements. That is also important. Okay, you have to, working capital is not taxable. So you have to calculate your tax. After calculating your tax before you come with the working capital issues. Okay, let's come to the depreciation side. Okay, let's come to the tax benefits. How do we get the tax benefits? Okay, so let's come to the tax savings. Okay, the tax savings, how do we go about it? So we have the years, we have the cost, we have the depreciation, and we have the tax benefits. Okay, so we are starting from year one. What is the cost of the machine? What is the cost of the machine?
250 million.
Okay. What is the capital allowance rate? The plant will be what? Be subjected
10
to,
years.
no,
10 years depreciation.
not 10 years. That is the depreciation for what? For
The
the
useful life is 10 years.
Yes, but that will be the depreciation for the company. But what is the, you are going to take into consideration the capital allowance that the tax authority will be giving to you. The company is not going to be granting the capital allowance themselves. It will be the tax authority that will be granting the capital allowance. So the plant will be subjected to accounting or tax depreciation at 25% using the reducing balance method. So this will be the depreciation rate that you'll be using because it is the tax authority that will be granting the capital allowance. So
Right.
you use the 25%. Most always use the rate given by the tax authority. If that particular rate is not available, then you assume that the tax authority is also granting the capital allowance like the way the company will also be doing it. Then you use a useful life. Okay, let's count to this place. So 25% on 250, what are you getting? I'm getting 62 point what?
5.
Okay. So what is the tax that you are what is the tax that you are paying on that particular figure? You multiply by the tax rate. What is the tax rate in the question?
30%.
Okay. So you multiply your 62, 250 times 0.3. This is a depreciation that we should have been taking, but we didn't take it. So we apply tax of 30% on this one. I'm getting 18.75.
Yes.
Okay, let's count to year 2. What will be the reducing balance? What will be the net book value? We are charging the depreciation on reducing balance basis. Okay, so what will be the net book value? I'm having 187.5. Okay, then we now charge the tax on it. I'm having 46.875. Then you find the tax benefits. I'm having 14.0625. Let's count to year 3. What will be the net book value? I'm having 140.625. Is that correct?
Yes.
Okay. Depreciation is 35.1563. Okay, let me just say 156. Okay. Tax will be what? 10.549. Okay. What will be the year 4? Is the year 4, the project life is only 4 years. The year 4, the way we did the capital allowance over here, the way we did the first one, the way we did this one will not be applicable for the year 4 because you can see that the machine is having a useful life of what? The machine is having a useful life of what? 10 years.
Yes.
But the product is what? The product is what? What is the product life?
4 years.
4 years. It means that after the 4 years, the machine will be used elsewhere, isn't it? So the machine will be, this particular value will be realized at the end of the 10 years. So we don't use this over here. You just calculate your normal depreciation. So after the 4 years, the machine will be used elsewhere. So our depreciation for the last year will be based on these figures. So it will be based on, so we have to calculate the carrying value as at this date, which will be 0.75 multiplied by 140.625. I'm getting 105.468. 468.75. Then you calculate depreciation on it, 0.25. 26.367. Then you multiply by your tax rate. Okay, 7.910. So that is what you're going to be doing because the machine will be used elsewhere. So you just take your tax benefit for 4 years on a depreciation. Okay. So this is what you'll be adding back to your profits. The tax is paid in the year in which profit was arise. So that is what they have said over here. So they say that the applicable tax rate will be 30%. Tax will be payable or refundable in the year in which the tax liability or the asset arises. So we are paying the tax in the year profit is made. So there will not be any arrears over there. So you have to put those figures over there. So that is for those ones. Let's now come to how do we go with the working capital requirements? How do we go with the working capital requirements? So you count your initial cost of 250 over there. You count your initial cost of 250. Okay. You count with your initial cost of 250. Please don't say that the machine is having 10 years. So what will be the cost that we are having for 4 years? No, don't say you are doing 4/10 times 250 because you are investing. No, you are buying the machine purposely for the project. So we take the full amount as the project. You can see that the machine will be, this machine will be having, every year will be 25. So don't say that you are using only 100 of it on the project. No, we use all the 250 because we are buying the machine because of the project. So let's now come to the working capital requirements. How do we deal with that particular issue? Okay. Okay, let's come to the working capital issue here. The company estimates working capital requirement to be what? 75 million. A 15% increase inclusive of inflation in the working capital requirement based on the previous balances is anticipated at the start of years 2, 3, and 4. So when are we putting in the working capital? The first one. When are we putting it? The
Year 1.
first
You said immediate.
immediate will be year 0 at the beginning of the year. At the start of the project, that will be year 0. So this 75, and then the 75 and then the 250, the 75 and then the 250, they all be put over here. So let's assume that we have the initial investment over here. So we have the 250 over here, and we also have the working capital of 75 here. They'll all be outflow. Let's come to the year 2. What are they saying about the working capital in year 2? They say that this will increase by what? The working capital will increase by what? 15% based on the previous balance balances. So let's look at the next year. What will be the working capital in the year 2? So let me do workings for working capital. Okay, so working capital will be working capital. So I'll have year 1. Year 1, the working capital will be 75 million. Okay, year 2. What will be year 2? It will be 15% multiplied by. So year 2 will be 1.0, 1.1. Let me do it 1 by 1. Okay, so that we can get it. So year 1, working capital requirement for year 1 will be 75, which is the immediate one. So let me bring year 1 here. So year 1, working capital requirements is 75 million. Let's come to year 2. Year 2, the working capital will be what? Will be 1.15 times 75. Am I correct?
Yes.
Okay. What are we getting?
It is 6.25.
Okay. 86.25. What will be year 3?
We are going to increase this one by 15%.
Okay. So year 3 will be 1.15 times what? 86.25.
56.
Okay. Or someone can also say the same as 1.15 multiplied by 75 multiplied by 1.15. Are we okay?
Yes.
Okay. So what are we having?
Get 99.19.
Okay. 99.19, isn't it?
Yeah.
Okay. I will tell you something about working capital. You don't have to send the total figure there. So working capital will be year 4 will be 1 point this one multiplied by this. So this will be times 9.9. What are we having? 114.07.
4.07.
Okay. 114.07. Okay. What we do for the working capital is this 75 will be carried across. Okay. So we have 75 at the beginning. This will be sent to year 2. But we are saying that year 2 now is what? The working capital for year 2. The total working capital at the for the year 2 should have been 86.81, but we already have 75. So for year 2, we bring only the increment of 11.25. We already have 75 that will be carried to year 2. But we have realized that the working capital should be using year 2 should be 86.25. How much should we add to the 75? It will be 1.25. So working capital will look at only the increase. It is treated as if it is a provision. So we look at the increase. Let's come to year 3. What are we going to be adding to year 3? Year 3, what are we going to be adding? What will be the working capital for year 3? I'm having 12.94. Is that correct? It is a difference
Yes.
between year 2 and this one. Year 4 will give us what?
$14.88.
14.
0.88.
Okay. 14 points. $14.88. Okay. You can also calculate these things like this. Okay. Calculate 15% on 75 and see something. 15% on
11.25.
11.25. So you can just be increasing them all every year. So this will also increase by 15. If you calculate 15, you get this. This will also increase by 15. You will get this. But the question says that the working capital, what is the total working capital that we have in the project now? It will be the total over here. This is the total, isn't it? Okay. At the end of the year 4, the working capital should be recouped at 11.04. This is the working capital that should be recouped. So the total working capital that we have put in the project should be recouped. So all this will be an outflow. All this will be an outflow. By the end of the year 4, the working capital that we should be recouping, which is the inflow, should be 114.04. But what is the question saying? What is the question?
60% of the working capital is expected to be realized
Okay.
at the end of the project. At the end of the project.
Okay. So let me
And the
come
project.
here. This working capital will be 11.25 over here. This will be 12.94. And this will be 14.88. Am I correct? Okay.
Yes.
If you come to the year 4, you should be recouping all the total working capital that you have put in the project, which is the sum of all these things should be recouped at year 4, which is the total of this. But they are saying that only 60% of that will be what? Will be recouped. So let's look at 60% of that. 0.6 times 11.07. I'm having 68.442. So you count to here, this will be 68.442. This will be an inflow. Okay, I'm sure that I've done with all of them. Then you just add them and discount them using the 32%. That's all. There's nothing to do again. There's nothing to do again. So the internal rate of return, the calculation will follow the same thing. Use the cash flow and now discount it to get these figures. So that is that. Tomorrow we try to see what we call the advanced issues by looking at what we call sensitivity analysis, lease or buy, and asset replacement decisions. A company will buy an asset and they want to determine when or how often they should replace their assets. If we have time, we can also look at what we call nominal and real net present value, or we can also look at what we call if you want to undertake the project and the projects are divisible and they are not divisible, how do we go about it? Okay, and what do we call capital rationing? Capital rationing is a situation where you have a project, but the money that you have available is not up to, and that is when we use the profitability index to rank the projects. Okay, so seniors, that is basically about everything. Let me save the working sheets and share with people that will be asking for it. All right. So please, do you have any question or any concern? If there are no questions, then we want to call it a night. God willing, tomorrow we meet and finish everything on the FM. Then you can go and do whatever you want to do in the exam hall. All right. Okay, so the silence means that we are okay. Okay. Since we are okay, I'm also okay. So that is that. We meet tomorrow, same time. Thank you all for coming. Good evening. So tomorrow, working capital management and this one again.